Given that, it seems like you're a little more concerned about inflation going forward, a little more concerned about valuation in bonds right now, specifically the long end, than some people. Talking about duration risk is more of a significant concern. Can you speak about how contrarian that has become as people sort of start to expect things to sort of have a soft landing and revert back to a lower inflation norm?
Yeah, I mean, I think, look, I saw you had a story about the inverted yield curve and how long it's been inverted. I mean, the way I look at that is it's a subsidy of long-term borrowers. In other words, the Fed wants rates at 5.25, 5.5, and the 10-year yield at 4.30 makes it much cheaper to issue long-term debt based off that benchmark. I think the danger that we have is that the long end of the curve starts to misbehave, that investors at the long end of the curve look for significantly higher yields. You know, fundamentally, there's no reason why the 10-year couldn't be at 5% instead of 4.3, and then that is when monetary tightening starts to finally be transmitted to S&P 500 type companies. And as I say, I think that's the risk. I'm not worried about an organic slowdown in the U.S. economy. There's no sign of demand falling off a cliff. It doesn't tend to just happen because the yield curve's inverted. You know, I say if you look at we look at this sort of, I call it an uneasy equilibrium. In other words, nothing's really happened for the last 90 days in any significant market. I think what would trouble me is if we start to see the long end of the curve really break out of its resistance levels.
Okay, well, I got to rip up the script here and go here. Mr. Dalio at Milken Institute agrees with you, and it's just simply we've got not a likelihood, but a sobering reality of price down, yield up. Does it solve itself quickly, where it's a one-off and we move back to some form of stability we've known, or is there real risk that we sit there for a while?
You know, I think these things tend to break out and then continue where they are until there's a problem. So, as I say, if we saw, let's say, a 10-year yield around 5%, I think it would stay there until it causes economic damage, and then you're in a downturn, and then yields bottom. But I don't think we're going to go back and see.
Yeah, but John, help me here. What does a 5% shell yield do to the mortgage rate?
Well, it depends when your mortgage is up.
Well, no,
right?
But I mean within the present market of 2024, 2025.
Well, based on where
8%?
we are at the moment, so we know that the outstanding mortgages, something like 9%, are paying 6 and above at origination. TK, that's going to take a long time. Yep. So let's take mortgages out of it. Michael, can we live with 5%?
I think certain portions of the economy can, and certain portions can't. As I say, it makes it harder to use leverage to generate income. Something like commercial real estate is much more vulnerable than residential real estate, just because of the way that borrowing takes place in that industry.
Michael Shao, this was great, as always, of Market Field Asset Management. Looking ahead as well to UAW in this negotiation deadline with Detroit's Big Three. Bloomberg's Craig Trudell on the looming auto workers strike. He's going to be joining us very shortly. He'll be catching up with us in about 5 minutes' time. Plenty of economic data in America as well. Jobless claims, retail sales, PPI today as well, Lisa?
Yes.
PPI 2, all of that in the mix at 8:30 Eastern Time. Before we get there, at about 8:15, you'll hear from the ECB. Rate hike or no rate hike from the European Central Bank and President Christine Lagarde. 30 minutes after that, you'll hear from Christine Lagarde herself in a news conference in Frankfurt, Germany. If you are just joining the program, welcome to the program. Equity futures on the S&P positive here by 0.45%. Coming up, Madison Fuller of JP Morgan Investment Bank. TK, tons to talk about with her a little bit later in the next hour, about 48 minutes away.
Everybody's got to rewrite, redo. I mean, I'm sorry, it's Labor Day, it's the start of a new season. There's so much news flow here the first 15 days of September that somebody's actually got to publish a 10-page report. We believe. In every single asset management house right now.
That's what it starts with.
Is going, we believe.
We believe.
Michael knows it's garbage. We suggest.
We're guessing. We're guessing.
We suggest.
We're guessing. We're guessing.
We believe.
Do you want to throw in some national politics in America? New poll from the Washington Post, Monmouth.
Missed that.
46% of potential Republican primary voters in South Carolina support Trump. The state's former governor, Nikki Haley, she comes in second. Tom at 18, Tim Scott at 10, Ron DeSantis all the way back with 9%. All the way back. That's the spread right now. I know South Carolina is unique given Nikki Haley's presence there, but Tom, is that an indication of just how big the gap is between Trump and the rest?
Yeah, absolutely. And, you know, each state's different, but yeah, the answer is yes. That is an indication of where we're heading, and It'll be interesting to see how Mr. Trump adapts to this, the language, who he supports, et cetera.
Does he have to adapt to anything?
Yeah, I think he's a cagey guy. He's seriously looking. He's going, okay, who's going to be my VP candidate? It's not going to be Mike Pence.
You think?
Good call. Yeah, I'm trying. But the answer is, he's going to be strategic about it.
Next year, it's going to be an interesting one, isn't it? Equity futures on the S&P positive here by 0.4%. There's a little bit of a lift in this equity market. Yields a tiny bit higher by not even a basis point. On your 10-year, 425.45. It is ECB rate decision day. Your euro is going absolutely nowhere. 107.33 from New York. Good morning.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Will the ECB hike or pause this week?
There's a lot in flux at the moment.
ECB, they're stepping harder and harder on the brakes.
You have to be cautious.
It's much too early to think about a pause.
Inflation expectations remain anchored at 2%.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Is there a real danger of over-tightening at this point?
Stopping too early is a bigger problem.
Coverage begins today on Bloomberg. Context changes everything.
The UAW northern part of the industrial belt part of the country is going to shrink no matter what. And in that situation, the incentives for the union are to get as absolute much as they can. This is going to be a difficult dynamic going forward for the economy.
Former Treasury Secretary Larry Summers on Wall Street Week with David Weston on the negotiations between UAW and Detroit's Big Three, and picking up on the sense of things that other people shared, Tom, that perhaps this is the last big opportunity to extract as much as you can out of Detroit's Big Three. And it's interesting to hear from the likes of Ford bring up the very viability and sustainability of the company based on what's on the table at the moment.
It is. It's going to be, it's history making. And of course, all of this is the heritage. And critically to your good insight, John, Joe Biden is looking backward on this. I don't think he's looking forward. Yeah, does the EV chat and that, but his heritage is so steeped out of Scranton in what, in my youth. And for him, it was, early politics. It's a huge backward look for the president. I don't say that in a mean way, but it's a lot of nostalgia going on.
If he's looking forward, TK, it's a 14-month time horizon. Let's be clear about that. Let's be clear about that. The election just around the corner. Looking at markets right now, equity futures positive by 0.4%. There is a lift here. Yields unchanged on a 10-year, 425.25. Crude, new highs for 2023. Once again, just short of 90 on WTI, 89.68. TK, we're up here by a little more than 1%.
We're going to do something really special here. If you have a grandfather who grew up pretty darn poor and did pretty darn good, he would only drive a Cadillac. And that Cadillac, when you stepped in it as a little kid, had a plaque on the bottom of the door where you stepped in, and it said, Body by Fisher. We go to Lansing, Michigan. He happens to be in London, but our Craig Trudell lived the UAW. He lived Michigan, and he lives what Joe Biden remembers until Fisher Body went out of business, I think, I'll say the 80s, 90s, maybe 2005. Craig, really honored to have you on today. Is this UAW behind the President of the United States, or has he lost them?
I think the UAW absolutely appreciates that Biden is much more of an ally and an ally to be trusted than the alternative in Donald Trump, the front runner on the Republican side. That being said, this is not a sort of cut and dry story. I do think that there are concerns about the fact that Biden has this long history of not being able to necessarily deliver on what the UAW has wanted in the past under the Biden administration. And that being said, there wasn't much that Biden could do. This is a union that's been, weakening for some time and absolutely is trying to sort of mount a comeback from decades of having to give up a lot of concessions for the fact that these companies were upside down.
But I'm going to assume your family was involved with UAW 724 in Lansing, Michigan. It's a changed union. If you were to go into that union hall like your grandfather went in years ago, what would be the different body language today? I hear a lot of anger, like they're saying, we're going on strike.
Yeah, I mean, I mentioned, this idea that this union was dealing with the fact that these companies were upside down. They had, they were paying so much for, retiree health care and benefits that it was putting them at this huge disadvantage to the likes of Toyota and Honda in the U.S. We got to this point over the last couple of decades of, undoing so much of that problem that was sort of, keeping these companies back. And that's led to this, deep sense of resentment that even as these companies have, gotten to a place where they're in a much healthier position, there's sort of a feeling in places like Lansing, Michigan of, hey, wait a second, these companies are healthy on our backs, right? And we've seen, these companies pay, good wages, but, for new workers, much less than workers who've been around longer. And so, they don't want this tier system anymore. They want, the sort of pay and benefits that their predecessors in decades past were able to enjoy. And there's a real question of whether or not that's feasible in this sort of modern paradigm that we're in.
Let's say we can't close the gap. Let's talk about tomorrow. Craig, how do you organize, plan for the potential for a strike if you're Ford, GM, Stellantis, when you have no idea where those strikes will take place, at what scale, in which locations? How do you prepare for that?
I think it's such a tricky thing to prepare for, and very much by design on the part of the UAW. So much about what we've seen with these negotiations have been unprecedented. It's a small thing, but in the past, you used to have the union and the car maker executives, shake hands over a table at the start of negotiations. The UAW said, we're not doing that. This time around, they're not picking one company at a time to target and to negotiate contracts with, and then trying to sort of replicate that contract with the other two. They're kind of negotiating with all three and threatening to strike all three, and be strategic about which plants they strike at, and to really sort of put the management on the defensive and not know what's going to happen here. And so I think the short answer here is they can't plan for this, and it does, really complicate things and make it a lot messier than what we're used to.
And on the flip side, when does the UAW kill the golden goose? When do they go too far? Have people put a number on what levels then really break the backs of some of these companies in terms of profitability and competitiveness?
I think one of the really interesting questions here is, whether we get to a point where the UAW is able to negotiate contracts that are attractive enough to interest, the sort of next generation of battery workers that are going to make, what the workers used to make engines and transmissions in the U.S. that powered cars. Can the UAW sort of, get enough from these companies to leverage into organizing more of the U.S. auto industry? I think, in the past, because of the position that the union has been in of decades of concessions, there hasn't really been an ability for the UAW to go to the rest of the industry and say, hey, come join the fold, be represented by the UAW after all these years of givebacks. And I think that's one of the things that sort of gets to the complication of whether or not there is a competitiveness issue. The UAW would make the case that yes, this would put these companies at a disadvantage, but we're going to go out and sort of claim the next sort of victim here. I don't think they would use that language, but they're going to try and leverage this into organizing more of the EV and battery supply chain in the U.S.
Craig, I know you don't have the answer to this question, but I really want to understand how you're thinking about it. What does this industry look like in 10 years, given the spat that we're seeing with China and Europe and China, a big effort from the United States with the Inflation Reduction Act? What are we heading towards here over the next decade?
I think it's such a difficult time to really sort of answer that question. And I think that's one of the challenges coming into play here from both sides. For the union, you don't know whether you're negotiating with companies that within the years of this contract may have to close some plants that are building engines and transmissions because of this transition, from the combustion era to electric. You don't know to what extent consumers are going to, still want to drive, gas cars and be reluctant to go to electric vehicles. And the same can be said for the companies, right? You look at Ford, a company that, has made a lot of noise the last few years about the transition that they're going to make to EVs. Just in the last few months, really sort of changed its tune and put more emphasis on hybrids. And we saw that just this week with the Ford F-150 hybrid. So there is so much to be said for the uncertainty facing this industry going forward.
There is nothing easy about this. Craig, thank you, sir. Craig Trudell out of London on the latest. TK, nothing easy about it whatsoever.
That was fabulous. He lived it. He and his family lived what Joe Biden's talking about.
Mike McCormick, TD Securities, up next. ECB rate decision, about an hour away.
and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Equities on the S&P positive by 0.4%, 1 hour away from data in America. We'll talk about that data in just a moment. Equities up on the Nasdaq by 0.4%. A little bit later, a strike deadline for UAW, Stellantis, GM, and Ford. All of that around the corner. Going into the ECB, your bond market's shaping up and looking like this: 2-year, 10-year, 30-year, 10-year, 4.26. Yields up a single basis point. 2-year, just shy of 5%, 4.98. 18, Tom, up a single basis point on the day.
Huge response to the kid from Lansing, Michigan being with us. Craig Trudell, I'm told, will join us tomorrow to see what we see tonight at 10 p.m. and midnight.
And we really don't know what we're going to see tonight at midnight. Just this big spread between what's on the table, something close to 20% from the auto manufacturers, and what UAW would like to see, which is 36 right now, Tom.
We'll see. I don't even know if we'll get the numbers tonight or that. We'll at least get maybe some of the path forward here on strike and who's involved, including Stellantis.
45 minutes away from an ECB rate decision. The euro shaping up as follows. The euro against the dollar, 107.32 and going absolutely nowhere. Coming into this week, 8 consecutive weeks of dollar strength against a weaker euro, and Lisa, there are many, many reasons why that euro has been weaker.
You know, we're talking about the UAW strikes, and it pairs into this story, actually, because Europe is at the crux of so many of the difficult stories, of some of the manufacturing questions of transformation with China. And they're just stuck between a rock and a hard place. How does the ECB handle and inject monetary policy into this mess, this toxic brew of different things? I mean, essentially, I can use that for this particular region with genuineness, because honestly, this is a difficult scene.
Javier Blas moving the market right now, making it more difficult for Christine Lagarde, for the president of the ECB. She's going to enjoy Brent crude breaking through $93 a barrel.
Toxic.
92.99 is not 93.00.
Get the euro on the screen and leave crude there. Crude at 93 and the euro at 107. And if Nomura's right, threatening to break down to 105, that is a terrible, terrible blend mix for the ECB and Christine Lagarde.
And I saw yesterday somebody modeling out a rationalization to get to 100 a barrel. My puny brain can't remember what it was, but in some form of futures market, or looking at Saudi light, which I do follow, which is the Saudi Arabian light oil, you can interpolate the extrapolate out. And right now we're at 100 a barrel under some measurements.
It's the rally that surprised big time.
That made no sense at all what I just said.
I'm moving on, Tom.
Move on.
Moving on. Building a bridge to the next segment.
Down
the surveillance
flames.
this morning. A slew of US data still to come, with PPI, retail sales and claims on deck. TK, it's the first time you've admitted that. Energy costs likely to put pressure
Javier
on
Blas is listening
prices.
over in Europe, is going, what in God's name is
Retail sales expected to ease on depleted savings and student loan repayments upcoming. Jobless claims last week. 216,000. Lowest since February.
We have a clock.
We're looking for 225 in about an hour from now. I want to turn to Europe, different story. Important, though. China's lashing back at the European Union after Commission President Ursula von der Leyen announced the new probe into subsidies for China's EV makers. The country's Ministry of Commerce saying the sector has gained an advantage through, quote, hard work and its own strength. The threat of potential duties weighing further on Chinese EV makers in Hong Kong trading. We're down across the board there. This is some real tension here. How do these manufacturers in Europe compete with these companies in China? How do these manufacturers in America compete with these companies in China as they make this transition, Lisa, which is increasingly expensive on top of the wage demands happening here domestically?
Add on top of that, that China accounts for about 2/3 of global capacity for processing lithium, which is the main ingredient for a lot of the electric vehicle batteries. So they are coming at this with a strategic advantage from the outset, and they have just plowed into the European market. The European market is trying late, very late, to fight back with some sort of limitations to what the Chinese automakers are bringing in. The U.S. has already done that. You know, it's a little bit rich for China to be arguing this on a lot of levels, but I will just say this to me is a debate and frankly, a war that's very much worth watching and really goes to the crux of
I'm
Europe's
so glad you brought
challenges.
that up. I looked at it yesterday and burst out laughing. Are you kidding me? We're lecturing the Chinese a totalitarian regime on capitalism.
Precisely.
I felt like it was a Davos. You know, it's a Thursday night at Davos. Your third cocktail party. You don't know who you're talking to, and they're talking about stewarding responsible capitalism.
I'm totally with you.
Are you kidding me?
Europe's a mess, Tom. Europe wants to set the rules. Everyone else wants to make a business. The United States has said enough. Let's have the Inflation Reduction Act. Let's support this transition to EV.
Do we want EVs?
China,
I don't have a
communist,
consensus on
centrally
this.
planned. Let's go, let's go, let's go. And Europe is like, slow down.
Yeah.
We don't have a plan yet.
Exactly.
Just follow the rules, please. Otherwise, you can't have access to this market. Just the European way. And to your point, does the demand even exist
I'm asking.
to make this transition?
I mean,
These
I live in a
governments are
bubble.
desperate, Tom, to convey their pro-climate credentials. For good reason, I understand all of that, but it's increasingly costly. The average family right now, can they afford an EV?
No, they can't afford a new car. The issue is John and I live in a bubble, moving around in our Bentleys and our Ubers. You lead a real life, Bramo. Are people out there actually able to charge up EVs?
Yeah, actually, when you drive around and you look at all of the gas stations on, you know, different highways, you can see EV chargers
And are
everywhere.
people lined up, waiting in line, arguing about how long it takes?
No, but at the same time, there are electric vehicles, even some dented ones, which means that they've had them for some time.
You've got to read the Granholm story.
This is another
Have you read the Granholm story yet?
I've
got to read the Granholm
I'm not going to be
story.
doing it during the show.
Should I interview her again?
Please. Yes, let's do that again.
Good luck.
I don't think that's going to happen anytime
All right.
soon. Rents in Manhattan, let's finish on that. Showing signs of leveling off. The median price for new leases was unchanged from July to August at $4,400 a month. The appraiser Miller Samuel saying new leases for August are down 14% from last year, may continue to fall. Median price in Brooklyn, remember that was cheap, $38.50. Northwest Queens, record high, $3,900. The good news, they're not going up so much anymore. The bad news, they're still around $4,000 a month, Tom. Just brutal.
You know, I'm popping the HP 12C here. We got the right calculator here. This is the one Mark McCormick would use. $4,400 a month is $52,800 a year. You got your taxes, federal, state, New York City tax.
What do you have to own?
Let's say, well, I'm going to go 30%. You got 176,000. You have to have 176,000 to pay roughly 1/3 of your income.
That's pre-tax. Pre-tax.
Yeah, pre-tax.
176.
Yeah, that's a big nut.
That's nuts.
It's nuts. I mean, it's not. And Jonathan Miller, we'll get him on here at some point with his great work. Mark McCormick's lived this. He's got 8,000 square feet overlooking the East River. He joins us right now with TD Securities. Mark, it's a breath of fresh air to have you on because we can actually talk about the markets and not this insane news flow. Bracket the euro right now. What is your conviction on where the euro will be 6 months from now?
So yeah, if we're going 6 months, we actually think euro will be higher, which is definitely out of consensus. It's not fitting the news flow. It's not fitting the themes that people are talking about. But these are the things that have been basically in flux the entire year. We started the year with strong U.S. data. Then we had the shift to the China reflation theme. Then we basically have moved back to King dollar through the summer with the bear steepening of the U.S. curve and essentially the focus on China real estate. But what's happening with the euro is really a function of what will happen with China and the U.S. evolving again on those themes in the next 6 months, which what we expect is by Q1 of next year, U.S. is in a recession. Fed is moving towards cutting rates. We think China starts to get its mojo back. We see the housing market and some of the financial indicators we're tracking in China are starting to stabilize. And while the ECB is basically going to be done around either now or at 4%, essentially the move for the euro will come through the combination of all these different global factors, which would help insulate it basically between this 107 to 110 range we've been trading. So on that perspective, a weaker U.S. economy is stabilizing China, basically reinforces topside euro 6 months from now.
Within that triangulation, what is the most opportunistic trade right now?
The opportunistic trade right now is actually interesting because it's not euro. It's actually playing the lines around the dollar. And I think one of the things that's been very interesting as a feature in FX is if you look at the dollar rebased through the entire year, it's done nothing. So it sits between a very strong LATAM and a very weak Scandinavian and even CEMA currencies, where basically the dollar sandwiched in between the two of them. So if you think about the themes that are working, carries working, terms of trade, you talked a lot about commodities in your last segment. The relative divergence in commodities, energy's up 30% in 3 months, base metals is down. So if you think about the things that are working in FX, the trades that we like capture these different themes, especially relative growth. So we like Swiss franc lower against the Mexican peso. We like China renminbi lower against India. We also like sterling lower versus CAD. So those three are currency pairs are definitely ways of kind of not really looking at euro dollar, but playing all the different major global themes are actually very impactful and actually the things that are driving performance in FX.
Let's just sit on the euro side of the cross a little bit longer. Mark, in about 35 minutes, we'll hear from the ECB. 30 minutes after that, a news conference with Christine Lagarde. How toxic is it to see crude at the height of the year and the euro near the weekend of the range of the year as well?
Yeah, it's not a great backdrop. It does fit into the stagflation concept. I think part of it, though, is do we want to put too much evidence on one manufacturing PMI, one round of PMIs? What's interesting is the context around European growth has changed. Like, we're not looking for a recession early next year. And again, we're looking more for a bigger slowdown in the U.S. So if you think about the context of the growth, Germany's weak, but the other parts around Europe are actually quite strong. So I think for the ECB, the challenge here is, yeah, they're lagging behind the U.S. in terms of controlling inflation. They are dealing with elevated inflation numbers that they want to continue to keep inflation expectations in check, while again the economy's slowing. So our bias here is that this is a coin toss. We're leaning towards them actually not hiking. But again, maintaining credibility around the fact that they can hike once again. They are highly data dependent. And the other thing that's going to be very interesting for this release is U.S. retail sales comes in basically right around the time when the ECB is meeting. So we're going to deal with another very critical U.S. data dump because the dollar and the euro in particular are following hard economic data surprises, which means retail sales, inflation, industrial production, real data, not the survey, not the soft data, is what's driving the dollar. It's also what's driving the euro. So if we have the ECB essentially in our base case on hold, but essentially following market expectations that they hike, and we get the weak retail sales number we're looking for a very big downside miss in the control group, that actually stabilizes the euro, given where positioning and valuations are at in our models right now.
I've got to squeeze this in. You just threw out a bone. Let's put some meat on it. Did you just say the US is going to underperform Europe next year?
Yeah, we're actually looking for a significant slowdown. So I put it in this context from the base effects of where we're at now. If you look at the strength of the data, the strength of the narrative, the focus on like king dollar, U.S. exceptionalism, no one's even considering that the U.S. economy is going to slow into a recession next year. So our call is that the U.S. slows into recession, and as a result, you have to get much more Fed tightening. Because even if you basically go with the baseline here of where the Fed would go on pricing and where inflation goes, they're still in super restrictive territory. They're not actually changing their monetary policy stance if inflation drops and they only cut by the 100 rates that are priced in. So essentially in our call, U.S. slides in recession. We continue to lose momentum through the labor market, through the credit side, through the banking channel. And as a result, the U.S. slides into a recession early next year, which we're not looking for in Europe. And as a result, you get more Fed cuts than's priced in through 2024. And again, we're still not looking for the ECB to kind of move as aggressively. They're just kind of lagging behind. And in China, again, is the other side of this, where
Sure.
a more supportive China environment would actually help to stabilize euro in a slowing U.S. environment.
It's quite a call. Mark McCormick, thank you, sir, of TD Securities. If you're just tuning in, welcome to the program. We're positive here on the S&P by 0.3%. The euro going absolutely nowhere, 107.32. That decision 32 minutes away. Bramo, that's quite a call from Mark McCormick. Recession in America next year, outperformance, relatively speaking, from Europe, given Europe's position at the moment.
I think it's fair to say that that's contrarian at this point, especially given where yields have been. It's pretty contrarian, although I will say his point about retail sales is notable, that the sort of barbell approach of retail sales in America expected to come in disappointing could offset some of whatever happens over in the ECB to at least give a bit of a reprieve to the euro.
Yeah, and we've hardly talked about it in the news flow today, but retail sales are going to be an eye-opener and frankly as valuable as what we saw yesterday in terms of lining up GDP.
Up first, retail sales a little bit
We need
later.
3 countdown clocks.
8:30 Eastern Time. Retail sales in America about 45 minutes away, 46 minutes away. And then we've got jobless claims and PPI as well. Lots coming up a little bit later, including this. Patrick Anderson of Anderson Economic Group on the looming UAW strike.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. The best question I get all night.
Bloomberg, top experts, great questions.
We're making progress at each of the 3 negotiating tables, but as you just heard, we're still very far apart on our key priorities. To win, we're likely going to have to take action. We are preparing to strike these companies in a way they've never seen before.
That was the UAW President, Sean Fain, outlining the organization's plans to strike against the big 3 automakers. The deadline hours away. Some fantastic research has come out of the Anderson Economic Group over the last week or so, calculating this, Tom, that just 10 days of strikes against GM, Ford, Stellantis would reduce US GDP by $5.6 billion and likely push the Michigan economy into recession. That data, Tom, coming from the Anderson Economic Group.
We're going to get right to this. It's so important, and we are so honored. Our team has just done a killer job of giving you original, informed voices on this part of America. It was great to talk to Craig Trudell growing up in Lansing, all of the Fisher body work that he knew in his family, and now we speak to someone also in Lansing, but truly expert on America's union and non-union auto business. Patrick Anderson owns the High Ground, the Anderson Economic Group. He is first call for everybody you can know at Honda, Toyota, obviously Detroit and Dearborn, and obviously a member of the Bow Tie of America card carrying
Is it a
group.
big? Is it a big club?
Thank you for the bow tie this
It's a
morning.
small
Patrick.
club, yes.
It's a small
Yeah.
club and a suspect at that. Patrick, I want to take with you not the usual UAW blah 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 right now, but I want to go down to Interstate 75, down to Kentucky, down to non-union Auto America. Do they win with this UAW strike?
You are driving the correct road here, my friend, my well-dressed friend. This is the big issue. A bigger issue than how much of a wage increase you get this year is, do you have a sustainable set of companies that can win in a competitive marketplace 2 and 5 years from now? And in fact, you don't have to just go down I-75, you could go on US 23. You have non-union automakers in Kentucky, in Ohio, in Georgia, in Alabama. You also have competitors in California. You have competitors in South Carolina. So yes, the most important competitive issue here isn't how much do you pay in wages, it's can you sustain your company making products that Americans want to buy 2 and 5 years from now.
Mickey Boehner of the New York Times, she lived and breathed Michigan. She just owned it, Livonia, Michigan, and all that. And she wrote a classic article 15 years ago in the Times about the end of Detroit. Now, I guess they sort of salvaged it and things are okay. But do you, as a grizzled pro, worry about Michigan 10 years from now?
I worry about being grizzled, actually, but I also worry about Michigan 10 years from now. And that's why you see our coverage or our analysis point to the things that are structural. And why we pointed out that, for example, the request to go back to what's known as a jobs bank and a defined benefit pension plan are existential and bankruptcy risks for the automakers. And I absolutely understand this. And when I look at Detroit and I look at Chrysler and General Motors, I say there's no rescue coming if these companies go bankrupt again. And the goal here isn't to avoid a strike. The goal is to have a sustainable automobile industry. And when you see this kind of rhetoric and you see the kind of demands that UAW Sean Fain is making, you see it's a real risk. And at this point, basically, I mean, that $5.6 billion is probably an underestimate of the losses that will be incurred if the UAW goes out on strike.
Patrick, the research that you've done has been the research cited in every publication over the past couple of weeks as people try to understand what the ramifications of a potential unprecedented strike against all three of these automakers would be. Have you heard from the UAW itself?
No, we haven't. And this is all independent work by Anderson Economic Group. But of course, Detroit's a small town. And of course, I understand that they're reading it and talking about it. And I think some of the statements that come back are, in fact, comments on this. President Sean Fain made a comment yesterday about all those analysts being wrong. Well, I hope he wasn't talking about me. I actually never said that they don't have the right to strike, or never said that they don't have a reasonable request for higher damages, higher wages. But it's also clearly the case that when you go on strike, you are causing damage. That's the goal. And the first people that get damaged are your own workers. They lose wages. But all these suppliers, and in this case, auto dealers, one of the things that's different between this time and in 2019, when the UAW struck General Motors for 42 days, is there's very little inventory now. So if the UAW goes on strike, like they're threatening to do, within days, automobile dealers across the country won't be able to sell cars. Within a week, they'll have parts difficulties. And, you know, there are other car makers and other dealers out there that are representing Honda, Volkswagen, Toyota, Hyundai, Tesla, and customers will not be interrupted in buying those. So I hope the UAW and Ford and GM and Stellantis keep in mind the goal here is to have a sustainable, profitable industry that pays good wages and not just get, you know, a quote win at the bargaining table or a big dollar amount If you can't stay in business, you don't win a strike.
But Patrick, isn't that part of the strategy that we might hear at 10 p.m. today from Sean Fain? That they're not going to go after all of them all at once. They're going to target things and that maybe try to just be selective about the damage so they can prolong the negotiations, kind of buying more time.
That is absolutely what this tactic has been announced. And I have to remind people that when you don't have a contract, the other side doesn't have a contract either. And this is not a de-escalation. This is an escalation. When you go out on strike and you decide to strike individual plants, what do you think the companies are going to do? I don't have an answer for that, but part of the answers are that you actually increase the damage and you harden the positions of the other people out there. Maybe they don't keep the plants open. Again, that's not my decision to make, but it's a real possibility.
Patrick, you're in Lansing. We had a really good conversation with our Craig Trudell, who grew up. His grandfather was Fisher Body with all the legacy there, World War II.
Yeah.
In the 50s, the 60s, the 70s, Cadillac boom. You know the story. And we had a great response. And a guy out on Twitter had a really smart note and his observation where he said, look, what's the union floor? Is it red or blue? And he suggested just possibly the union floor wasn't for President Biden. Is the union behind the president, or is he looking at another time and place?
A wild card in this, and something that I've pointed out and that Sean Fain has pointed out, is something that we've never had before. We have huge taxpayer subsidies going to build battery electric plants, joint ventures with Chinese and other foreign automakers to build cars that right now represent substantially less than 10% of the U.S. market. And here, the auto workers and the taxpayers are actually kind of on the same side. There's a great deal of skepticism about whether this makes sense, about whether it's a good expenditure of taxpayer dollars. And for the point of view of the UAW and the automakers, it's an extremely risky business decision to invest so much and actually shut down plants that are making products that Americans are buying and that are making money for the automakers. So that's the wild card in this. It's not part of the wage demands, but it is definitely underneath it and is definitely worrying the White House. And it's definitely a wedge between the UAW, a traditional supporter of Democratic presidents, and this Democratic president.
Patrick, this was excellent. Thank you, sir. Patrick Anderson of the Anderson Economic Group. We'll be sending him a slim tie as well at some point.
Yeah, we should.
We should do that too. Just just to mix it up a little bit.
Absolutely.
Brahma does not approve of that. Both sides.
I mean, what are you talking about? Why is everyone projecting everything onto me?
Just the place we're pulling as you.
It's Thursday.
I think that
if we had the Bramo cam up, I'm sure it would show that Bramo did not approve.
I believe I saw that.
I think people should wear whatever they want to wear.
Okay.
Within reason, you know.
All right, sure.
Do you think he'd actually wear the skinny tie? I don't think he would. I think he'd use it.
Slim. Madison Fowler of JP Morgan Investment Bank is coming up a little bit later. We've got an ECB rate decision about 20 minutes away. After that, we've got some interesting economic data for you. We've got jobless claims, PPI, we've got retail sales as well.
Slow down.
And 15 minutes after all that data, you'll have a news conference with Christine Lagarde, Tom, the ECB president.
For those in America, this news conference is going to be really, really interesting. An opening statement, and then the Q&A, John. You've been in that room. Wow. It's going to be...
multiple questions, a lot of follow-ups.
I find it
staring
more
at some
enjoyable.
notes.
You know? I think McKee should go over and get the last question.
I'm anticipating that. Yeah. McKee on tour would be very cool.
Pretty good. Yeah.
That would be very cool. From New York City, this is Bloomberg.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I don't think we are close to stagflation at all. Look at the positive momentum in this economy.
The services piece, which is what Powell cares about, is still running much hotter than people expect and want.
Higher energy prices is going to continue to cool spending by the consumer.
The ammunition is drying up for the consumer to some extent.
The market is more worried about inflation than maybe it needs to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's the quiet hour here on radio and television. Nothing going on except 3 countdown clocks and 14 minutes and change, an ECB ruling. John, I guess that trumps all, including what we see through the evening, the UAW strike possibly to come.
Well, let's deal with the next hour first, Tom. So in about 14 minutes, as you say, an ECB rate decision. 15 minutes after that decision, tons of data.
Retail
sales, PPI, jobless claims. 15 minutes after that, 8:45 Eastern Time, we have a news conference with Christine Lagarde, the ECB president. And Tom, there are some banks out there who think this governing council is about to hike interest rates. Goldman is one. Citi is another. Bank of America, HSBC, they think the deposit rate could go to 4. I can tell you, based on a range of estimates at the moment, we are split right down the middle. And the reason things have changed is off the back of a report a couple of days ago from Reuters suggesting that people around this decision are going to be looking at forecasts showing CPI next year not above 2%, above 3% for 2024. Does that change the calculation that this ECB needs to make in 14 minutes?
What's the so what for Americans? And the answer is it's right now a global movable feast. Action in China today on rates. Even Ukraine had a rate adjustment lower as well. And I would suggest what happens in Frankfurt here in 13 minutes, 7 seconds. It does affect Chairman Powell. It does affect America.
I would say this, that Frankfurt is exposed to all the wrong stories in a way that the United States is not. The slowdown in China, the fragility in the energy market. Think about what Europe's exposed to on the energy side at the moment. The United States, thank goodness, has output near all-time highs in America right now for crude. That's the good news. The bad news for Europe, Brent's in the 90s. The euro is weakening. Germany's potentially in recession for the whole of this year based on forecasts we're going to get from the German government. And inflation is sticky high.
Okay, give me Brent intraday here. Lisa, right now Lagarde's looking at her Bloomberg terminal in Frankfurt. She's got the one with the big screens, you know, like 4 screens.
With everybody
and all that. And she's looking at Brent crude, $93.18. Brent is on the move this morning.
They have a very difficult situation right now. And the key question to me is how much of this is a global story and how much is a Europe-specific story? What is the differentiation of inflation in Europe versus the U.S.? Are we seeing disinflation at a time where wages are going up, where services sectors are still sort of leading, but sort of kind of falling off as well in Europe? Right now, it seems like the market is expecting the ECB to get to 4% by the end of this year. Why not go now and then just say, we are now done for the foreseeable future, and we are going to see how much damage is being inflicted?
John, Brent crude in euros, we usually don't talk about that, in euros, from the end of June, up 31%, annualized, up 261%.
Nailed
what
it.
else do you need?
Nailed it. This is why it's
there?
so toxic, Tom. To
Javier
have Brent
Blas
at
taught me to do
93,
that.
the euro at 107, and if Nomura's right, we're going to 105 and it gets worse. This is a mix, the blend you don't want to see at the ECB. Energy prices picking up again, just as the euro starts to weaken again because the economy's not doing well.
Data check. I'm going to go right back to Brent crude here. $93.16, up $1.28. You're going to get a 90 print on NYMEX here in moments.
Totally unchanged on the euro into this decision, 12 minutes away. 107.30 against the dollar. Yields a little bit higher on a 10-year in America, up a single basis point to 425.85. And equities, Tom, elevated through most of this morning. We're up by, let's call it a third of 1% on the S&P.
Right now, this is an important conversation. All the kids are back in college, and every once in a while, you get a kid that goes to school and they do what's called a double major. There's Williams, PP&E, and other schools around America. Wharton's got a wonderful double major in computer and business. And then there's South Bend, Indiana. They pieced together a couple years ago an economics double major, and one of the outputs of that is Madison Fowler. She joins us now, J.P. Morgan, London, investment strategist there. Madison, South Bend, I know, steeped you and steeled you for the cacophony we're in right now. My head is spinning. What will you listen for from Christine Lagarde?
Sure, thank you for having me. I think what's really key to listen for there is, are we going on to more of a hawkish hold, or, is it more of a dovish hike? And I think that's quite important. But I think at the same time, though, even going into this meeting, we did pencil in about one more hike from the ECB for the balance of the rest of this year. And, I think when we think about, is there a debate over whether it's this meeting or whether it's in a future meeting, I think the ECB is very clear that they want to be closing this chapter on rate hikes. But I do think that Lagarde will be really trying to preserve that optionality. And so I do think that she'll be using uncertainty as a tool in order to do that.
Madison, are they confronting stagflation?
I think the risks for stagflation are certainly higher in the euro area than they are in the U.S., for instance. So the ECB is in a tough spot because we've seen growth start to, I think, unwind more quickly than expected. You can see that in the PMI data, especially the services figures, which have decelerated more quickly than anticipated. But at the same time, inflation remains quite high. You have both headline and core prices still above 5% on a year-over-year basis. So that's quite difficult from a policymaker standpoint. We still do think that inflation will continue to cool over the balance of the year as the labor market should hopefully cool. We are seeing a rise in some of the unemployment numbers. But yes, to your point, the stagflation risks are certainly higher.
They're set to forecast inflation above 3% for 2024. Madison, do you see it coming below that by year-end next year?
I think it's difficult. I certainly think that if you don't see inflation fall more quickly, I think the conversation is certainly going to switch into how long does the ECB need to hold interest rates at this really elevated level for. And from that perspective, I think it's really difficult to see the ECB starting to cut rates really at all in 2024 until you start to see that inflation number start to move lower.
That said, there was something that Mark McCormick of TD Securities said, which was highly contrarian, where all of this, yes, higher than expected inflation comes on the heels of stronger growth in Europe than the U.S., which is his prediction. Can you get on board with that?
I think it's harder to see higher inflation if growth is weakening in the euro area. So at some point in time, these two things start to reinforce each other. And so if you see growth momentum continue to weaken quite considerably in the euro area like we are today, at some point in time, I think you do have to think that inflation is going to follow. It's just going to take, I think, a little bit longer than people were otherwise anticipating.
So do you think that right now what we're going to hear from ECB, from Christine Lagarde, is patience? Are we going to hear this sense that you can wait and you can see how things progress and maybe just pull a Jerome Powell and basically hint that it's okay if it takes until 2026 to get inflation down to 2%?
Yes, I think that's fair. I think that's part of the reason why they're using uncertainty as a tool in order to preserve that optionality of doing that. But I think so long as they are seeing continued progress towards, moving towards those goals, I think that's a positive indicator. And I do think we also need to keep in mind that the ECB is a single mandate central bank with price stability, that 2% inflation goal, really important to them.
Away from the ECB remit, Madison, I'm fascinated by the JP Morgan position in the continent of Europe and the United Kingdom as well. Do you find U.S. equities relatively attractive right now from your desk in London?
I think in the short term, yes. I will take a step back. At the start of the year, we did come in with a view for European equities to outperform the U.S. from a broad market basis, and I think that did track. But as the euro area economy started to slow, as we saw momentum shift, we, I think, transitioned that call away from the European broad market and more so into European national champions, which are companies that are based in Europe, but multinational companies that are leaders of their industries and are still demonstrating a degree of pricing power. So I think it's more about where in Europe you're really focusing rather than a U.S. versus Europe conversation.
She has the chat so down. If you say something tracked, that means you sort of kind of like got it right. That tracked.
Novo Nordisk. I think Novo Nordisk, when I hear her talking about those themes. Madison, thank you. Madison Fuller there of JP Morgan Investment Bank. With us around the table, I'm pleased to say, going into this rate decision from the ECB, Eric Nelson, macro strategist at Wells Fargo. Good morning to you, Eric. Rate hike or no rate hike from this ECB in 5 minutes' time?
We think it's a pause, John. Obviously, finally balanced, and we had the Reuters decision the Reuters report earlier this week. I would not say that this is something that I'm fully buying into as a signal of what the committee is actually going to do. Look at the speech from Schnabel a couple weeks ago. I thought that was actually pretty balanced. I think if she really wanted to push for a hike, she would have. And I think she's probably the most prominent hawk on the committee at this point.
So question. Forgive me for asking this because we don't really know the answer, but why do you think they leaked it? What do you think the purpose of doing that was?
The question is, who's they, John? Was it a rogue hawk or two who wanted to push for a hike and push pricing, or was it, the overall committee? And that's what we really don't know.
There is this question, though, of whether they're going to emphasize patience or whether they're going to emphasize their primary mandate, at least in name, which is inflation. What would be the justification for a pause, given that inflation really hasn't come in as much as they expected, especially if they increase their inflation forecast for next year?
Yeah, this is challenging optics, right, Lisa? I think you have to look at not just the growth situation, but also the pace of hikes. Right, they've done a lot of tightening, almost 500 basis points, 450 basis points or so. They've come from negative territory. So I think even just skipping here is justifiable, even with inflation where it is, given the growth outlook. The question is, how do you communicate a pause?
I mean, we just got moments ago, West Texas Intermediate through $90 a barrel. The Eric Nelson rally in Brent continues. We're at $93.27 as well. What's the so what here for Americans? You've got great perspective on this. Why do Americans care about Europe in a monetary and not even having a combined fiscal policy mess?
Yeah, I mean, certainly it's a massively important economy in a broad global scheme. But I think if you look at the sort of the policy outlook here, right? I mean, you have the ECB having done almost 450 basis points, and you really are seeing a spillover into the economy, the real economy now, the credit conditions. The question is this something we should be thinking about for the U.S. as well? And you look at lending standards, you look at lending conditions in the U.S., you are starting to see some transmission of policy.
John, anecdote as we await for the ECB decision.
You price in hotels
in Paris,
now.
A hotel in Paris, 480.
Oh, boy.
And then the demand of it is now 800, and I just looked, and it's just under $1,300.
It's getting expensive.
For the same damn room I stayed in at 480 not that long ago.
That's the foreign demand.
That's the American madness about Europe that
Let's
colors
talk about
us.
domestic demand. Can domestic demand in Europe hold up? Look at where the euro is. Look at where crude's trading right now. The euro's at 107. Some people, Nomura, call him 105. Crude's through 90, WTI, through 93 on Brent. Surely that higher energy price, that weaker euro, it's just brutal for the Europeans at the moment.
It's a nasty mix, John. I think the question, and back to Lisa, you brought this up with Mark McCormick's comment about relative growth. The question is here is not so much obviously you want to know what's happening in domestic demand in Europe and, on an isolated basis, but on a relative basis, can the U.S. recession be deeper than Europeans' recession in the first half of next year? That's certainly possible. From a real policy rate standpoint, can the Fed cut more than the ECB next year? I think absolutely. So that euro, dollar story can turn as we get toward the ends of the year. But right now, where I'm sitting, it looks pretty negative for the euro.
So 105 in sight for you next couple of months?
I think 105, 106 is where we head.
But for next year, what are you thinking about?
I think we could see a rebound back toward 110.
Okay. It's a pretty tight range, though, isn't it? 105, 110.
Yeah, but these guys do. They play to pennies. You and I are looking at like big decisions.
I wanted some big numbers, Tom. 115, 120. Here's your guide for the next 45 minutes or so. In about 2 minutes, an ECB rate decision. 15 minutes after that decision, some data in America. US retail sales, PPI, jobless claims. Jobless claims last week, the lowest we've seen going all the way back to February. They've come down, down, down over the last month.
And they model it back a survey from what, 216 back to 225?
Still
do they just
exceptionally
guess
low.
that? Is that like a dartboard guess? How do you do that?
TK, without a doubt, Bramo, we do call that a guess, don't we?
We always do. I mean, honestly, this is just basically a rough estimate, which is the reason why nobody really trades on it that much, unless they do, in which case, if it comes out surprising. I think retail sales might be the most important event, though, of the day.
I heard people say that in anticipation of CPI. That maybe more than CPI, retail sales was like the data point of the week.
100%. Couldn't agree
more. The countdown clock says we're selling the ECB nut right now. We sell retail sales after.
It's related.
I was trying to do that.
It's actually related, though.
I was going through the clock, Tom, the next hour, and then you'd wanted to talk about claims and all that good stuff. So the ECB in 30 seconds, data after that. After we get that data at 8:30 Eastern, I'm going to complete this. 15 minutes after that data, you get a news conference with President Christine Lagarde. Going into this rate decision from the ECB, we're split right down the middle. No hike or hike. You take a guess at home. Going into it, the euro looks a little something like this. On euro dollar at the moment, we're at 107.31. We are totally unchanged on the session as we anticipate this rate call from the ECB. I'm looking at the German curve with yields coming in a basis point or two right across the curve. The 2-year in Germany at about 3.15. The 10-year in Germany down about a basis point. There is your rate hike from the ECB. They come in with a 25 basis point move. We go from 3.75 on the depot rate to 4%. On the marginal lending facility, we go from 4.50 to 4.75. On the main refinancing rate, we go from 4.25 to 4.50. It is a 25 basis point rate hike from the European Central Bank. We were split right down the middle on no hike or hike. We get that hike. The euro looks a little something like this, actually dropping and weaker against the dollar, 107.10. We're negative here, Lisa, by 0.2%.
Seeing inflation this year at 5.6% versus the prior forecast of 5.4%. The key here will be communication at this point. Is this the last one? Is this going to be Christine Lagarde coming out and saying, this is it? We're now going to wait. And that might be a cleaner message than a hawkish pause.
The call for 2025, they see inflation slowing to 2.1% in 2025. So, Tom, what we've got here is a 25 basis point hike and a ton of estimates as well. The growth estimate for GDP, Tom, for 2023,
there it is,
0.7%. The previous forecast, 0.9.
Lawrence Summers walked by me yesterday in our acclaimed food court. We enjoyed greetings. And this is a Larry Summers report. And the basic idea here is inflation. No, the growthiness of this will be on the data screen in 10 minutes.
We've got Maria Tadeo alongside us in Frankfurt, Germany, inside the headquarters. I just want to share with you the lead paragraph from the statement. Inflation continues to decline, but is still expected to remain too high for too long. The Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. In order to reinforce progress towards its target, the Governing Council today decided to raise 3 key ECB interest rates by 25 basis points. Maria Tadeo from Frankfurt joins us right now. Maria, what stands out for you?
Well, Jonathan, it is a hike, which, as you see, there had been a lot of volatility in market sentiment. But of course, it was that report that came out by Reuters. Then Bloomberg confirmed it, that the European Central Bank saw inflation actually spiking next year in 2024. And that was a crucial year, Jonathan, when it comes to the transmission. The entire decision, and we talked about this many times, hinged around the idea of transmission. If you believe transmission was strong enough, you could pause. If you believe it had not, then there was a case to make this rate hike. I think, to me, it also makes sense because, Jonathan, when you come out with a report like that 48 hours before a decision, you completely change sentiment in the market and provide this platform for a hike. Today would have been a massive U-turn not to hike. The other thing to me that is interesting now, beyond the actual decision, but the language, is that they reinsert this idea that the European Central Bank will maintain sufficiently restricted levels when it comes to their monetary policy. Again, it is always a balancing act. They hike. It sounds hawkish. I wonder, though, in this press conference, how is Madame Lagarde going to balance it out with an economy that clearly is now in a downturn, and they're hiking into this downturn. And it's not just Germany and manufacturing. We should make that clear. It is now spreading across the euro area, and it's also now spreading into services. So it is an economy that is weaker, and this is a nightmare scenario they said they wanted to avoid, by the way, when they started hiking into a downturn.
The elephant in the room right now is the energy story. Maria, I'm just working through the forecast in their statement, so let me share it with our audience. The September ECB staff macroeconomic projections for the euro area see average inflation of 5.6% in 2023, 3.2% in 2024, 2.1% in 2025, an upward revision for 23-24, downward revision for 25. And as they point out, the upward revision for this year and next year mainly reflects a higher path for energy prices. How much of this is about domestic price pressure, and how much of it is about just being exposed to this higher energy story?
Well, look, this is a complicated picture for the European Union, because we know it's not just the energy prices now, which have dropped dramatically and significantly, but it really is the second round effects, the repercussions on the fallout that is done for the European industry. Again, you're at the mercy of a complicated energy space for the European Union, and they're very clear that as long as the war in Ukraine continues, and I am sure she's going to reference this war, they are facing a volatile scenario. The other issue, of course, that features into the energy story is the implications for growth. Again, they're cutting their growth projections, which again should not be a surprise, because you had Paolo Gentiloni on the show, and he already did that and cut their forecast for growth. The question is whether we're heading into stagflation or not. That is a word that, for the time being, everyone wants to avoid.
Now, Maria, you're living this viscerally. I mean, you're really, really steeped in this. Dovetail the growth forecast marked down, essentially a run rate of 1% to be charitable for 36 months, with oil at $93 a barrel. It doesn't compute. To me, the inflation story's almost been pushed aside.
Because the growth picture is bleaker. And again, that was the whole argument, Tom, and you make a good point as to why this market was split. And not just the market, but really the governing council going into this meeting, again, suggesting this is an economy that is weaker. There is obviously a downturn that is manifesting. And of course, this is a single mandate central bank, but it doesn't operate into oblivion. It does it in a way where obviously the economic perspective matters. And again, it goes back to this idea and some of the criticism of the ECB, I should point, from a number of countries, that they missed an early window to hike. Then obviously inflation was not a one-off, but it was entrenched now in this economy, and now they find themselves in a situation where the prospects for growth are challenging, they're difficult, of course, and you continue to hike. So yes, Tom, it's not just about inflation. I think it's a very fair point to say the economy also featured in this conversation, not so much to tip the balance. Obviously, the European Central Bank has now gone for this hike. The question, though, is whether she signals this is the last one, precisely because all of the issues that you mentioned.
There's a strong hint of that in the statement. Maria, thank you. Maria Tadeo there in Frankfurt. So this is what you've got. 25 basis point hike. Upward revision to the forecast for headline inflation for this year and next year. Downward revision, actually, for core CPI. The bulk of that, an energy story. A cut to the growth forecast for every single year, basically. They now expect the Eurozone economy to expand by 0.7% in 23, 1% in 2024, 1.5% in 2025. You're about to get a strong hint of what you may hear in the news conference with Christine Lagarde from the Governing Council for the ECB. This line right here, Tom, Based on its current assessment, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Is the ECB telling us they now believe, based on their forecast, they are sufficiently restrictive?
I'm in the camp that you're dead on, and they got a single mandate. I get it. It's a different set of rules than Jerome Powell has. But to me, John, everything has been overwhelmed in our analysis by oil over the, I'll say the last 2 weeks, but frankly, over the last 3 months, let's call it. And the growth forecast, to me, I know it's not what they do. We're not supposed to talk about it. Rates. You know what? They're in recession.
Energy is at the heart of this. The growth outlook is absolutely terrible.
Yeah.
The market at the moment, I think, picks up the scent that they're done. The euro's weaker off the back of it, break of 107, 106.97. That can change in the news conference, of course. You look across the German curve here, Lisa, got a move of 5 basis points to the front end. On a 10-year, you're down 6. The 2-year is back to about 311. That's the initial knee-jerk reaction off the back of that statement.
Well, it's easy to read the statement that way, also saying that past rate increases continue to be transmitted forcefully. In other words, the rate increases are still acting with some sort of lag.
Eric Nelson, your thoughts on this one?
I think the market's telling the story right now, John. You look at the yen, and it's strengthening pretty meaningfully against the euro. The growth fears here clearly accelerating. To Lisa's point, policy transmission working its way through. And to your point, John, this sounds like they're done. Now we'll have to hear what Lagarde has to say. I think the market will still be in flux here. But if they communicate this as a one and done, I don't see how the euro rallies here.
How much are they going to try to signal that the inflationary push is entirely from energy, and they've got to be cautious with that? Really lean into that story, given the fact that they actually downgraded, as John was saying, their core expectation for inflation both next year and the year after.
Yeah, I think that's certainly a sensible thing to do. I think that the challenge here, though, is if that's the communication you opt for, then why did you hike today? If the upward inflation revision for 2024 is mostly energy driven, and supposedly you hiked on the back of that, I think you have to balance that communication. So, look, it's a single mandate central bank, but they do have increasingly focused on credit conditions and growth, and I think they're becoming more concerned about things on that side.
Before we got this, you said that you expected to be sort of in a 106, 105 range for the euro. We're already breaking down from that 107 level, 106.97. Can you revise your forecast based on this preliminarily, just sort of like back of the envelope? Does this make you more bearish on the euro than you were before this announcement?
I do want to hear what Christine Lagarde has to say. But I think if this is a one and done, and the GDP forecasts are coming down, and this is the way they want to play this, look, maybe you do get a bit of a short squeeze into the next couple days. If it's hawkish and there's reason for rates to in the short term at least to move higher, but I continue to want to fade that, and I think the curves will keep flattening, and we'll be back at 106, 105 in a couple days.
With your Johns Hopkins economics, Keynes was right. When the facts change, Eric Nelson changes. What does this oil and growth matrix of Europe do in the foreign exchange space? To me, we're a place where we weren't 2 weeks ago. Certainly, we're at a place we were not at the end of the summer, call it August.
Yeah, I think part of it, Tom, of course, is the oil story, but also thinking about natural gas prices, right? So,
thank you. Well said,
let's talk about both of those. I mean, on the oil front, it's only gotten worse, and it's probably going to get worse before it gets better. So that's Euro's being one of the largest energy importers and oil importers out there. Is going to be another downside risk. But the question is, what happens to gas prices? And storages are still quite full. There's a lot of people worried about European winter and natural gas, and to the extent we see that gas prices actually go the other direction, head lower, could be a bit of an offset to think about.
Let's put a bow on this and just reflect on where we've been over the last 18 months. It's easy to get carried away. We've got a strong suggestion here the ECB might be done. They're going to say they're data dependent. That could change. We may well hear that on repeat from President Lagarde in 20 minutes' time. Did you ever think they'd get to 4% on the depot rate when this all started? I never dreamt of that. I never thought we'd get anywhere near 4%, and here we are.
Absolutely, John. I think Yeah, I remember back in 2021 and 2022, I think people thought that 1 or 2% would have been, kind of the 2011 moment or the 2008 moment, right? Another farcical hike.
It may well still be.
It's possible. It's possible. But look, this is there's been a lot of tightening done here, and I think you're seeing it really filter through here, more so than you're seeing in other economies, and I think that speaks to the sensitivity and also the level of neutral rates in Europe.
Raises the hard question. We had a decade, the best part of a decade, of negative interest rates and QE forever. Are we ever going back? Are we done with that now?
Not for a long time, John. I never say never, but I think the genie's out of the bottle here. I think the question here is, especially if we're looking at even the BOJ is talking about rate hikes, and that tells you where we are.
What a change. What a change. Eric, great to experience it with you. Eric Nelson there of Wells Fargo. If you are just joining us, this is what we've had from the European Central Bank, a 25 basis point hike. We take the deposit rate from 3.75 to 4%. They've upgraded the outlook for inflation for this year, for next. They've actually had to bring in the outlook, take it down for core CPI. All of this, a strong suggestion that driving that headline story is crude prices, it's energy. The growth outlook is absolutely dreadful, but ultimately the next move, TK, sounds like a pause, looking at this ECB statement that we get this morning. And I'll share that quote with you all again. Based on its current assessment, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Are they done?
I'm going to go back to Keynes. When the facts change, I change. Lagarde has changed. She's not the same Lagarde as at Jackson Hole. Absolutely flat out. The way oil's moved here, the way the Saudis have manipulated the price, she goes up on stage today different than the conversation at Jackson Hole.
She has a free pass to pause, to actually be done now, because this is what the market is expecting, for her to be done. And
She's
this is what the market is
mandate,
processing.
and you're right, the single mandate's overwhelmed.
So at this point, she can come out and say, we want it to be sufficiently restrictive, not maybe in those words, in the not more fanciful words that you just said. We got there, and now we see. Now we wait, and we get a sense of how much this transmission policy is going to work through the system.
And with TK, though, Bramo, you get the feeling that in the last 2-3 weeks, Tom, this energy price move has really encouraged the hawks to go into the Governing Council meeting in the last couple of days and make a change. I'd be interested to see what the thinking was behind this move, because we certainly didn't get a strong guide towards an interest rate hike, Tom, from President Lagarde when you sat with her in Jackson Hole, Wyoming. In no way, shape, or form was there any suggestion at all they would sit down and deliver 25 basis points today.
And this is the heart of the matter, and Matt Boesler was great in the Lodge explaining this to me, Patrick Lane, and all the rest of it. She wants a more omnibus 60,000 view, a longer-term analysis of what we're going to do. I get it all. Crystals and pyramids, great. That was the name of the speech, and I was honored to speak to her. You know what? Oil moved. All of a sudden, it's like Mike Tyson hitting you in the face.
Yeah.
And I'm sorry, this is a different press conference than I expected, sitting there, waving with her at the Elk. Hi, Elk, how you doing?
Everyone's got a plan, Tom, until they...
And that's happening right now. And to Eric's brilliant insight, can that come over to the United States?
You said crude made a move. We're through 90 on WTI a little bit early this morning. The euro with a break of 107 at the moment, 107 flat, negative a third of 1%. The next stop for this story, data in America, retail sales, PPI, initial jobless claims. Mike McKee dropping by to get up to speed on that. Mike McKee, what do you see?
Well, let's forget about Christine Lagarde and what she thinks for a few minutes and think about what the market thinks Jay Powell will think, with retail sales up 0.6% on the month of August. That is significantly higher than the 0.1% that was forecast. Ex-autos up 0.6%. And the retail sales control group, waiting on that one to come in here. Hold on just a second. That's being calculated as we speak. A couple of other numbers. Initial jobless claims, 220,000. Now, we don't know what the revision is yet. It was 216 last week, but it does tell you that we're still in a very low claims environment. Continuing claims are at 1,688,000. PPI has just come in as well. PPI for final demand up 0.7%. That's a significant increase over the 0.3 the prior month and 0.4 expected. If you look at the core, which we look at as ex-food, energy, and trade services, that's up 0.3. compared with a 0.2 rise last time. So we are seeing some inflation pressures at the basic level of the wholesaler. So we are seeing some problems with inflation, but retail sales so far not being affected. Retail sales control up 0.1%. That is a lot less than the 1% last month, but it's better than the 0.1% decline that was forecast. So retail sales strong, jobless claims are weak, which could be translated as strong, and PPI does show some inflation pressures. You guys check the markets. I'll see what made up the retail sales report.
Mike McKee, thank you. It gets better for America just as it gets worse for Europe. Compare and contrast the front end of the curve in Germany and the United States. The 2-year in Germany, the yield is lower. In America, the 2-year is higher. An upside surprise on retail sales in America off the back of that. Yields up on a 2-year by 5 basis points. We're back through 5% on a 2-year. In the FX market, the euro 106.63. We're negative there by 0.6%. TK, what a mix in the last 15 minutes. Going into President Lagarde in about 13 minutes' time.
DXY, the blended average, I believe it's 54% weighted euro. DXY index, a traditional dollar index, is nicely through 105 and goes out to new highs over the recent number of months. Watching oil, it really hasn't changed off the shock of what we saw in the last hour. And, you know, the bottom line with the news flow here, we just continue. We have retail sales. Michael, give us the control group. And then we got to go to Helene Becker's conversation earlier. Oh, yeah. Meanwhile, back at the races, Ed Bastian wanted to get into the news flow.
Energy at the epicenter of the outlook for inflation in Europe. It's at the epicenter right now for the outlook for the airlines in America. Just to get you up to speed on the latest from Delta, sees third quarter adjusted EPS of a range of 185 to 205. They had seen previously 220 to 250. They still see full year adjusted EPS of $6 to $7. The estimate there, 658, just marginally lower. We had some downgrades to the outlook yesterday from Spirit. We had it from the likes of Delta right now. We've heard it from American as well. It's Delta right in front of us at the moment. You put it all together at the moment, it's all about energy. Higher fuel prices hitting the airlines. In Europe, it's hitting the outlook for inflation. Lisa, in America, just as the ECB comes out 15 minutes ago and downgrades the outlook for growth for every single year, we print a big upside surprise on retail sales in the US.
This is almost the worst case scenario for the euro heading into this. What would have been worse is if the ECB had come out and not hiked rates and said that they were done. Otherwise, basically, this is exactly what people did not want to see. The US outperforming and the European region showing itself as not flat on its back, but something like that. The clarity here to me is that the US economy has enough momentum with the surprising data to the upside again and again to withstand the higher oil prices. Does Europe? And that, to me, is one of the key questions at a time where they're battling both inflation and waning growth.
Yeah, I look at it and it's just a great day for news flow. This is a really key day in the year, John. I mean, it's just,
That's
you know,
pretty
all
amazing,
the things
TK,
going
yeah.
on. It's amazing. You know, your head's spinning. There's
Let's
no
put it
other
all
way
together for you.
to put it.
If you are just joining us, I'll do my best to wrap up the last 20
luck with
minutes
that.
or so. 25 basis point high from the ECB. We were split right down the middle. The outlook for inflation for next year, above 3%. That was widely expected, according to reports we had going into this ECB rate decision. The outlook for core, actually take that in a little bit. The bulk of this move for headline inflation in that forecast is all about this move in energy. And that contributes to this downgrade to the outlook in the third quarter for Delta. Then we get the US data. US data surprising to the upside. Retail sales strong, headline 0.6%. The control group, plug that into GDP, positive 0.1% for the month of August. The estimate, negative 0.1. So things better in America, worse in Europe, and they might have to stop raising interest rates because the growth profile is absolutely terrible. Yields are up on a 2-year in the States by 5 basis points and back through 5%. In Germany, the 2-year is lower by 3 basis points. So yields up stateside, yields down in Germany. What does that mean? Stronger dollar, weaker euro, break a 107 in the last 15 minutes, 106.66. All the wrong numbers over in Europe right now, TK. That currency pair down 0.6%. And it's up to President Lagarde to pick the message in about 10 minutes' time.
We're going to see that from Christine Lagarde. We welcome all of you on Bloomberg Television and Bloomberg Radio. And this is a great honor. Just as a small aside, I was with John Riding when we learned of the Madoff scandal. Far before that, he wrote essays in economics that synthesized criticized his Bank of England, his Fed, long ago at Bear Stearns and now at Breen Capital. And to have John writing with us on this historic moment for the ECB is an honor. John, one of your great essays was The Putting Green of the Fed. Is Christine Lagarde on the golf course? And does Christine Lagarde have any clue where the pin is on the green?
Well, Tom, thank you for referring back to a note that I think goes back to 2004, maybe earlier, so no one knows what we're talking about. The idea
That's
was...
why the show's so popular.
The idea was, back at the time, the Fed was making very small moves in raising rates, and Bernanke was talking about lagging the putts, but I was saying that, are they even on the fairway? Because they were so far from neutral. Now, this is a very different story. We are clearly on the putting green. We're certainly on the putting green in the U.S., and maybe it's a gimme come next week. Some of these inflation numbers, a little bit of a warning with CPI yesterday, PPI today.
You live this. You live this at Bank of America. Yeah. They invented the ECB. Duesenberg came in. Trichet, John screwed up. Is that the proper answer?
Had a couple of difficult moments in 2008 and 2011.
This is an historic moment for Lagarde this morning. You say she's on the putting green?
No, I said the Fed was clearly on the putting green, and maybe it's a gimme. The ECB, I still think, is probably a chip shot away from the putting green, but they're not driving off. They made a huge adjustment, but inflation in the Eurozone's 5.3%, projected to go higher. It's still significantly above the policy rate, so they have negative real rates. Now, I know that rate hikes can't do anything about oil prices. Rate hikes can't make the winter milder in Europe and ease any potential gas situation. But the mistake that was made in 2021 by central banks around the world was in allowing supply chain issues, energy price issues, then war in the Ukraine issues to filter in to the broader price setting behavior. And that's what central banks have to push back against. I think the Fed so far has done a pretty good job. I think the ECB isn't quite there yet. Well, and I think they have to be very careful not to tell the markets that they're there and that this is the last rate hike, because what do markets do when you think you've got the last rate hike is you look for the first rate cut, and that's way too premature. Just a word on those retail sales. Not quite as strong as you think, because I believe there was a downward revision to the July increase in the control group from 1% to 0.7%. I don't know what the June issue was, revision might have been, but the U.S. consumer is strong. In the third quarter, GDP now was 4%. I don't think it's probably going to, for consumers, real consumer spending, I don't think it's going to change very much on that, the Atlanta Fed's estimate. It's not that the U.S. is roaring, it isn't, but it isn't yet falling into recession, perhaps unlike the Eurozone, given the size of the interest rate adjustments.
Is the big takeaway here that the central banks are almost done, or pretty much done, and now we have to look at the underlying economy and how strong the economies are, and that Europe is not nearly as strong as the U.S., cannot withstand the oil price shock that might be coming down the pike, and thus is in a worse position with the euro set to fall?
Well, I think the Eurozone is in a worse position, and then you have fiscal issues in a number of countries. There was some brief mention of Japan. I would say that Japan is in an even worse position because they haven't even begun to consider hiking rates yet. And yet they've got an underlying inflation rate that continues to go higher and is above 4%. So if the U.S. is much better placed than the Eurozone, which is, as I said, maybe it's a chip shot away from the green of monetary neutrality, but the Bank of Japan's still in the clubhouse.
They're in the bunker, the ball's plugged. It's so much worse than you're describing. Surely, in Europe right now, they've had to downgrade the growth outlook. They've had to upgrade the inflation outlook. They're basically doing their best to signal to pause without signaling a pause. Do you sense any decisiveness out of this governing council whatsoever this morning?
I don't know. We'll have to listen to the press conference and the questions and see where that goes. But let me just go back in 2021, maybe even in 2020, when all of these extraordinary efforts during the pandemic, and much needed were being done. I warned multiple times that if you do too much or you don't pull it back soon enough, you're going to end with an inflation problem. So the consequences of what we're seeing now isn't the consequence of the ECB hiking to 4.5% from negative rates. It's that they left those rates there too long, as the Fed did, but the Fed did a better job of catching up. And that puts them in a better position now. I think the ECB still has a little bit of catching up to do. And yes, there's probably a recession out there, may well be in recession, but you know, it's like omelets and eggs.
I got to squeeze this in. John's going to go to Lagarde here in 3 minutes, so we got about a minute and a half for a killer question for our audience. You nailed that we would have higher inflation. It took a while to get here, and maybe the path was stranger than we thought, but you nailed that we would get to this point. Should our listeners and viewers be afraid of the new rate environment, or can America adapt and prosper in this rate environment?
I think after the adjustment, America can adapt. I don't think we're going back to the very low interest rates that we had pre-pandemic. You just look at the housing market. You've got a 7.5% mortgage rate, and I bet if you ask most people a couple of years ago, mortgage rates were 7.5%, what would the housing market be doing? No, I don't think anyone would have imagined it could be as strong as it currently is. Now, that's not to imply everything's rosy, and I still think the U.S. faces a recession in 2024, but the glide path to that is so much stretched out because of all the cumulative excesses. The large number of jobs, 1.4 jobs still for every vacancies for every job seeker. Still a little bit of excess savings from the pandemic, but that's mostly worn down. It's a very, very long glide path. And I just think people might let the guard down a little bit too soon on the recession chances as some firms have,
Interesting.
I think, for 24.
Okay, John, I don't remember the last time we had a 20 minutes like the one we've just had, Tom. Last 25 minutes or so.
This is a huge
Incredible,
deal.
right?
It's a huge deal. Yeah.
Tons of economic data stateside. I want to get back over to Mike McKee just for a second look at the data we had in America. Mike, big upside surprise on retail sales.
And an upside surprise on PPI, and both of those attributable to oil. You guys nailed it at about 8:28 this morning, just before we got the data. Oil prices driving this up. Gasoline station sales up 5.2% in the month of August compared to just 0.1% in the month of July. We did see in retail sales a number of things that point to pretty much normality, including a 0.9 rise for the second month in a row in clothing and a 0.5 rise in health and personal care. So people got their haircut, they bought new school clothes. It was a typical back-to-school season. The other thing in PPI, it's a 2% rise in the price of goods, which the Labor Department attributes to oil prices. 60% of that rise to oil prices. So PPI being pushed up by oil, and so are jobs, so are retail sales rather. The jobs numbers, 220 for jobless claims last week, revised to 217. So a slight rise, but still historically low. So at this point, it is hard to see a lot of bad news other than energy in these reports this morning.
Mike McKee, thank you, sir. As Lisa mentioned privately in the chat a little bit earlier, 1-2 punch for the euro right now. Data great in America. In Europe, I've got no idea what the outlook is. For inflation, it's higher on headline at least. For growth, it's lower. The euro, a break of 107, 106.81 as we anticipate that news conference beginning with ECB President Christine Lagarde. First reaction on the south side, TK, from Deutsche Bank. A lingering pause is being signaled, but it's a low conviction pause. The ECB has retained the option to hike further if necessary. There is no declaration of victory on inflation. I don't think you'll hear that declaration in a minute's time.
Victory Lap Gentiloni at IMF, he was brilliant 4 or 5 months ago. Not so much on eurosclerosis, but just skepticism on the new growth, the vibrant growth of Europe.
Just taking some photos at the moment in Frankfurt, Germany, at the ECB headquarters. We'll get some brief introductory remarks, and Lisa, then this one starts. Questions for Lagarde in this news conference. Bramo, there are many.
Yeah, how high is the threshold to hike again? What would she have to see to hike rates further? Is she done? Why is she getting conviction? Why did she raise rates now, given the fact that she spoke to one Tom Keene and Jackson Hole and signaled something else? I also am wondering, Is the European economy that much more vulnerable to higher oil prices than the U.S. economy? And are we going to see that reflected in that currency pair increasingly on the heels of oil?
TK, what a tough spot for the ECB chief in this news conference.
Well, the history of it is there. We were mentioning this with Mr. Ryden, the idea of going from Duesenberg to Trichet. They're making it up as they go. And with all of the politics here, the nuances here of the different nations, she'll bring that in. You're going to hear that.
Tom, 4%. Did you ever think we'd see it at the ECB?
Absolutely not. No, and I'm not the adult you are. You're the one that really has a handle on this. I'm not that up to speed on European monetary dynamics, but a 4 number? Never.
Never thought we'd get there. They were at 375.
They don't have the nominal GDP to sustain it.
Not at all. They're at 4% now, and based on their outlook, they certainly don't have the nominal GDP to sustain it. A cut to the growth outlook for inflation, they had to kick that one higher. Here's the ECB chief, Christine Lagarde.
For our online participants, if you ask a question, please turn on your cameras and your microphones. And with that, I hand over to President Lagarde. Please.
Thank you so much, and welcome to all of you after this summer break that I hope you enjoyed. The Vice President and I welcome you to our press conference. Inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. In order to reinforce progress towards our target, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. The rate increase today reflects our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The September ECB staff macroeconomic projections for the euro area see average inflation at 5.6% in 23, 3.2% in 24, and 2.1% in 2025. This is an upward revision for 23 and 24, and a downward revision for 25. The upward revision for 23 and 24 mainly reflects a higher path for energy prices. Underlying price pressures remain high, even though most indicators have started to ease. ECB staff have slightly revised down the projected path for inflation, excluding energy and food, to an average of 5.1% in 23, 2.9% in 24, and 2.2% in 25. Our past interest rate increases continue to be transmitted forcefully. Financing conditions have tightened further and are increasingly dampening demand, which is an important factor in bringing inflation back to target. With the increasing impact of our tightening on domestic demand and the weakening international trade environment, ECB staff have lowered their economic growth projections significantly. They now expect the euro area economy to expand by 0.7% in 23, 1% in 24, and 1.5% in 25. Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restrictions. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The decisions taken today are set out in a press release, which is available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So turning to the economic activity. The economy is likely to remain subdued in the coming months. It broadly stagnated over the first half of the year, and recent indicators suggest it has also been weak in the third quarter. Lower demand for the euro area's exports and the impact of tight financing conditions are dampening growth, including through lower residential and business investment. The services sector, which had so far been resilient, is now also weakening. Over time, economic momentum should pick up as real income are expected to rise, supported by falling inflation, rising wages, and a strong labor market, and this will underpin consumer spending. The labor market has so far remained resilient despite the slowing economy. The unemployment rate stayed at its historical low of 6.4% in July. While employment grew by 0.2% in the second quarter, momentum is slowing. The services sector, which has been a major driver of employment growth since 2022, is now also creating fewer jobs. As the energy crisis fades, governments should continue to roll back the related support measures. This is essential to avoid driving up medium-term inflationary pressures, which would otherwise call for an even stronger monetary policy response. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Policies to enhance the euro area's supply capacity, which should be supported by the full implementation of the Next Generation EU program, can help reduce price pressures in the medium term while supporting the green transition. The reform of the EU's economic governance framework should be concluded before the end of this year, and progress towards capital market union should be accelerated. Looking now at inflation. Inflation declined to 5.3% in July, but remained at that level in August, according to Eurostat's flash estimate. Its decline was interrupted because energy prices rose compared with July. Food price inflation has come down from its peak in March, but was still almost 10% in August. In the coming months, the sharp price increases recorded in the autumn of 2022 will drop out of the yearly rates, thus pulling inflation down. Inflation, excluding energy and food, fell to 5.3% in August from 5.5% in July. Goods inflation declined to 4.8% in August from 5% in July and 5.5% in June, owing to better supply conditions, previous drops in energy prices, easing price pressures in the earlier stages of production chain, and weaker demand. Services inflation edged down to 5.5%, but was still kept up by strong spending on holidays and travel and by the high growth of wages. The annual growth rate of compensation per employee remained constant at 5.5% in the second quarter of the year. The contribution of labor cost to annual domestic inflation increased in the second quarter, in part owing to weaker productivity, while the contribution of profits fell for the first time since early 2022. Have become more aligned, and the contribution of past energy price increases is fading out. At the same time, domestic price pressures remain strong. Most measures of longer-term inflation expectations currently stand at around 2%, but some indicators have increased and need to be monitored closely. So what's our risk assessment? The risks to economic growth are tilted to the downside. Growth could be slower if the effects of monetary policy are more forceful than expected, or if the world economy weakens, for instance, owing to a further slowdown in China. Conversely, growth could be higher than projected if the strong labor market, rising real incomes, and receding uncertainty mean that people and businesses become more confident and spend more. Upside risks to inflation include potential renewed upward pressures on the cost of energy and food. Adverse weather conditions and the unfolding climate crisis more broadly could push food prices up by more than expected. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation higher, including over the medium term. By contrast, weaker demand, for example, due to a stronger transmission of monetary policy or a worsening of the economic environment outside the euro area, would lead to lower price pressures, especially over the medium term. Turning now to the financial and monetary conditions. Our monetary policy tightening continues to be transmitted strongly to broader financing conditions. Funding has again become more expensive for banks as savers are replacing overnight deposits with time deposits that pay more interest, and the ECB's targeted longer-term refinancing operations are being phased out. Average lending rates for business loans and mortgages continued to increase in July to 4.9% and 3.8% respectively. Credit dynamics have weakened further. Loans to firms grew at an annual rate of 2.2% in July, down from 3% in June. Loans to households also grew less strongly, by 1.3% after 1.7% in June. In annualized terms, based on the last 3 months of data, household loans declined by 0.8%, which is the strongest contraction since the start of the euro. Amid weak lending and the reduction in the euro system balance sheet, the annual growth rate of M3 fell from 0.6% in June to an all-time low of minus 0.4% in July. In annualized terms over the past 3 months, M3 contracted by 1.5%. So in conclusion, inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. In order to reinforce progress towards our target, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, Madame Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde. Thank you very much. My first question would go, a general one. How did the discussion go? Because clearly before going into the meeting, there was much room for the so-called doves, but also the hawks. So how did you come to a compromise? And the second question, is that a dovish hike, meaning that's it now? Or is it a hawkish pause? Of course not a hawkish pause, but is that the end of the rate hiking cycle, or do you leave the door open?
Thank you very much for your two questions. So how did the discussion go? We had a lot of data, a lot of analysis done by staff, and obviously this was a projection meeting, and projections that was prepared by the ECB staff. So we looked very closely at all those data. And to give you an example, we spent hours and hours yesterday, morning and afternoon, with the usual presentation by staff in the morning and by the chief economist and the member of the executive board responsible for markets, to have as much as possible intelligence, numbers, analysis. And I'm pleased to say that at the end of this morning session, we came to the conclusion that we shared the analysis that was conducted on GDP, on inflation, on anticipation. And obviously some members did not draw the same conclusion. And some governors would have preferred to pause and reserve future decision once more certainty, more intelligence would have resulted from the passing of time and the impact of our many previous decisions. But I can tell you that there was a solid majority of the governors to agree with the decision that we have made and that I have just read to you. So yes, there are a few members in the Governing Council who would have preferred another one, and we had to rely, as I told you, on a solid majority. It is not the practice to give numbers of who did what and when, but suffice to say that the majority was solid. And it was a very, I don't want you to believe that we had an antagonistic, adversarial discussion. We really went deep into the numbers and the analysis and tried to really take into account the sensitivity analysis, the scenarios that were provided by staff, really discuss the baseline and the impact of our measures in the past. And I'm happy to go through the process that we followed in terms of reasoning. Now, on your second question, is the door open or is the door closed? It was a beautiful theater play by Marivaux who said that a door has to be either opened or closed. But this is theater. And what we have decided is actually reflected in that key paragraph, which I have read twice because it is in the body of the text, which was released to you earlier, and also in the conclusion of the text, which is that, and it has caveats, based on our current assessment. So it is based on all the data, the numbers, the analysis, the assessment, the projections, and any other information that we have available. We consider that the key ECB interest rates have reached levels, note levels, that, maintained for sufficient long duration. So there is the time element that comes up, will make a substantial contribution, those are heavy words, to the timely return of inflation to our target. And that we don't stop here. The whole paragraph is important and needs to be read in symbiosis. So the next sentence says, our future decisions will ensure that the key ECB rates will be set at, repeating, sufficiently restrictive level. That's number one. For as long as necessary, number two. Those are really two parameters that are going to guide us very much. Not that we are forgetting about the three components that have guided our reasoning so far, and we continue. We will continue to follow a data-dependent approach. You've heard that before. Data-dependent approach to determining the appropriate level and duration of restrictions. In particular, our interest rate decisions will be based on our assessment, and I repeat there, it's in the text. Number one, inflation outlook in the light of the incoming economic and financial data. Number two, the dynamics of underlying inflation. Number three, the strength of monetary policy transmission. So that addresses your question, and I think that the exegesis that no doubt some of you will conduct in relation to substantial contribution and how that substantial contribution contributes to means significant level maintained for as long as necessary based on current assessment gives you the answer to your question. Thank you.
Thank you. Now turning to our online participants, I'd like to give the floor to Balazs Kourani of Reuters. Balazs, please.
Good afternoon. Thank you so much for taking my questions. First question is about asset purchases, President Lagarde. Is 2024 carved in stone for PEP reinvestments? And if not, do you expect a discussion on the APP? Do you expect a discussion about outright sales of bonds? The second question is about the growth outlook, which is about, I guess the question is whether a recession is becoming your base case for the Eurozone. Do you expect a recession perhaps in the third and fourth quarters, or do you still believe that the quarterly numbers continue to remain positive?
Thank you very much for your two questions. On your first question, we regard interest rates as the key tool in the work that we are doing in order to reach our 2% medium-term target. So we have not discussed the PEP program and the reinvestment and the forward guidance. PEP is our flexibility instrument, as you know, and is the first line of defense if we want to defend proper transmission of our monetary policy. We have not either discussed any kind of APP outright sale. And on your second question, I want to... Sorry, you're missing a little bit of happening here on the floor because something is falling. But you're not with us, so I have to tell you what's going on here. So, you are correct, Balazs, that the GDP has been revised significantly. We moved from 0.9 to 0.7 in 23, and more importantly, we moved from the 1.5 to 1% in 24. But let me just take a moment to explain to you what seems like the biggest revision, which is 2024. Most of it, actually 3/4 of that revision, 0.5, is actually attributable to carry over from 23. So we are going through a period of about 5 quarters of very, very sluggish growth. And we are, based on our projection, coming to the end of it. And the pickup, according to the same calendar, the same quarter calendar that we have had in the June projections, picks up again in 24. The downgrade from 1.5 to 1, as I said, is carryover from 23. In 25, we have a small revision, and we move from 1.6 to 1.5, which is really a minimal revision. But in essence, the recovery that we had planned for the second half of 23 is actually pushed out into time for various reasons that I'm happy to expand upon. But that's what we are seeing.
Thank you. And the next question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon.
I'm here for you. Two questions as usual. You say that the current level of interest rates will make a substantial contribution to fighting inflation if maintained for a sufficiently long period of time. Did you have a discussion in the Governing Council what sufficiently long means in practice, for how long rates will have to stay at the peak at the very least? And then as recently as when you gave a speech in Sintra, you said the ECB is unlikely to be able to call the peak in interest rates in the near future. Just wondering what exactly made you decide that now's the time to at least allude to the fact more strongly. Thank you.
You know, I'm not going to annoy you with the rereading, but you obviously all picked up that the level, our two key determination are level sufficiently restrictive for long enough so that we are confident that we are reaching the 2% medium-term target. And as indicated in that paragraph that I have read, under current assessment, we believe that the interest rates that we decide will provide a substantial contribution to that target. But with the two elements, sufficiently restrictive, number one, for long enough. Now, your real question is, did you discuss the long enough? And the answer to that is no, because we're also saying in the same breath that we will be data dependent. So what we want to do is continue to be data dependent and test our assessment that I have just described for you against future projections and subsequent assessment. That's what we are tasked to do, with the determination to reach the 2% medium-term target in a timely manner. Now, you had a second question. Oh yeah, Sintra. You know, we are not saying, I'm not changing anything from Sintra. I stand by what I said and I wrote in Sintra. And we are not either saying that we are now at peak. I think the sentence that I read is really the critical one. With today's decision, we have made sufficient contributions under current assessment to returning inflation to target in a timely manner. And as I said, both elements matter, the level, sufficiently restrictive, and the duration. But it's obvious that the focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
Right, and the next question.
I know it's complicated because the as long as necessary cannot be actually pinned down, and the substantial contribution cannot be either pinned down, because it's every time an assessment that we have to conduct against the data, against the analysis, against the various information that we derive from experts, and against the projections and what our staff offers.
Okay, thank you. And now the next question goes to Aude Kersilek of BFM Business. Aude, please.
Thank you for having my question. At Jackson Hole, you told that the ECB has to maintain its credibility with the public. How do you evaluate the ECB's current credibility? And second question is, 15 years after Lehman collapse, do you think that banking system in Europe is safe from such a crisis? And what about the shadow banking?
Those are big questions, you know. So, on credibility of a central bank, I know that the experts will give you probably a lot of measurements and surveys and indicators to determine whether the central bank, ours or any other central bank, is credible, is losing credibility, is gaining credibility. What I know is that the ECB is on a positive path directionally. But my definition of credibility is that we deliver on our mandate. Our credibility on the line is to reach the 2% medium term in a timely manner. And we will do everything we have to do in order to to deliver on that. That's credibility. You have a mandate, you have to deliver against that mandate. On the stability and strength of banks, my dear Vice President.
Good afternoon.
Oh, thanks.
Well, 15 years after Lehman, I think that the situation of the banking industry in Europe is totally different. Banks are much more resilient. This is something that we have reiterated several times. The capital levels, the quality and the level of liquidity are not comparable to the situation 15 years ago. And I think that that makes a big difference. And I think that we have a very good example, what happened in March. In the US and with Credit Suisse, you know, these kind of events didn't have any impact on the European banks. And after that, we had our stress test exercise that indicated that the European banks, that they are resilient, that they can withstand even, you know, a very severe scenario. And I think that this is a proof that the situation has changed quite a lot for better. Perhaps now the attention is much more on the non-bank part of the financial system. I think that there, you know, in terms of financial stability, we have identified many more vulnerabilities now, but and you know, that's the focus of attention that we are putting now in terms of financial stability.
Thank you, Vice President. The next question would go to Martin Arnold of the Financial Times. Martin, please.
Thank you. President Lagarde, two questions from me. Firstly, what do you say to people who might accuse you of making a likely recession worse and adding to the woes of the Eurozone economy? Second question is to ask you whether the expectations that national central banks and the European Central Bank are likely to make sizable losses in coming years, is that having any impact on your discussions? Is that something that is having any impact on your decisions at the ECB? Thank you.
Well, thank you very much, Martin. I will dispose of the second because I think it's going to be a fast response to your point about whether the likelihood or possibility of national central banks or the ECB to make loss, does that impact on our decision-making process and our decision? The answer to that is no. Because, and in a way it addresses also now your first question. No, because the objective that we have, the mandate that we were given, is price stability. It is not to make profit. It is to procure price stability within the euro area. And I would observe that the fight that we are leading, we're not the only one, but the fight that we're leading against inflation is making progress. And what we're doing today is trying to reinforce that progress. Remember back in October, we were at 10.6. We're down to 5.3 now. So it's been divided by half. Is it satisfactory? No, because it is, and it is expected by our projection to still remain too high and for too long. But inflation has declined, and we want it to continue to decline and to reinforce that process. And we're doing that not because we want to force a recession, but because we want price stability to be there for people who are taking the brunt of inflation, high prices, and predominantly so those who are not the most privileged people.
Thank you, President Lagarde. And the next question goes to M&I, let me just check the name, Santiago Pinol, I'm sorry. Santiago, please. Santiago Pinol of M&I.
Hello, good afternoon. My question is, if the data dependent and held for long are at odds at each other, and if this can be contradictory, and if you are prepared to cut rates if growth slows further. In other words, it's sufficiently restrictive, that sentence could imply a cut. Thank you.
This is not even a word that we have pronounced. But yes, the data dependency applies to both the determination of the sufficiently restrictive level as well as the length of time where it has to stay at that level. So we don't see any contradiction in terms in having the two components in the same sentence. One will drive the other, actually. And on your other, I think I addressed your second one.
Thank you. Then Christian Siedenbiedl of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you. Good afternoon. Madame Lagarde, how much are the problems in the real estate market affecting the ECB?
Well, thank you for the question, because that's certainly an area, whether you're looking at residential real estate, which affects, obviously, at the end of the day, households and people, or whether you look at commercial real estate, this is a sector that is clearly responding very much to the current circumstances. The level of interest rates and the financing tightening that we are conducting to bring inflation down is one of the factors that that cause this overall real estate sector to be in a difficult situation at the moment. I mean, we're not oblivious to it. We know it, and you know, as I said to Mr. Arnold earlier on, we are not driven to sustain and support a particular sector. We are driven by the imperative of delivering on our mandate, which is price stability. And we want to do that timely.
Thank you. And the next question goes to Eshe Nelson of the New York Times. Eshe, please.
Good afternoon. I'm Isha Nelson from the New York Times. Can I ask for your assessment on the pace and the strength of the transmission of monetary policy? You noted the fastest contraction in household loans. Do you feel that monetary policy is transmitting as quickly as you would like, too quickly, too strongly, or slow enough? And then in the past, you've talked a lot about the ability for wages to keep rising as long as companies absorb those labor costs in their profits. Are you starting to see that be possible, or is there a risk of either kind of wages diminishing or profits returning to where they were?
Well, thank you so much for the two questions. On the transmission channel, there is evidence that the current hiking cycle is transmitting to financing conditions faster than previous ones. So you will remember that we use three three elements in our assessment. One is the inflation outlook, the second one is underlying inflation, and the third one is the strength of monetary policy transmission. On the third one, I think we all shared the same view in the room earlier today, that this channel of transmission is strong and stronger than we have seen in previous cycles. So when you look at how fast it transmits to various rates, whether it's overnight or whether it is longer term, it's extremely rapid. And it's reflected in the lending rates for corporate, in the lending rates for household, which I think I mentioned as 393, and in the monetary policy statement. There is a transmission, and it is having a constraining impact that is visible when you look at M3, when you look at the volume of loans, when you look at the interest rate. So it's really clearly the fact that transmission is effective, and more so than in the past. Your second question. So one of the bright spots that we have in terms of activity in the euro area is the labor market. The labor market is still going strongly. The employees' wages is growing. The employee remuneration is still increasing at 5.5%, and the participation has increased by 0.2%. We are beginning to see some signs of weakening in the volume of hires, and notably in some sectors that are related, particularly in the service sector that is related to manufacturing. We are beginning to see some signs. But overall, when I look at my numbers today, it's employees' remuneration plus 5.5, employees' participation in the economy 0.2 plus, and the lowest unemployment rates we ever had. So, and we're looking very, very carefully at that because it's having a serious impact on inflation, particularly inflation in the service sector, which is typically much more labor intensive. Now, what are we seeing in terms of profit? When we look at profit unit cost and its growth, it is still growing. But that growth is, for the first time, having an inflection downwards. So that would comfort the assumption that we have made throughout. We made that at the June projection. We are making it yet again. It comforts the projection that gradually profit will squeeze in order to allow for the wage increases. We're beginning to see it. This is the first time. So we want to be confident that is a lasting component. It should normally be so, because as demand is dampened, it should normally be the reaction in the corporate world. Thank you.
Thank you. I think I saw Chiara De Felice of ANSA asking for the floor, right? Or did I not? No? No, that's okay. Then Eric Albert of Le Monde, please.
Thank you very much for taking my question. I'd like to come back on the housing market. You've mentioned, of course, that interest rate hikes have dampened the housing market. But how much of a drag on overall growth is it? How much of a systemic risk is it? And that might also be a question for Mr. De Guindos. And then in your first question, in your first answer, you were saying you could elaborate on how you reached the conclusion of doing a hike today, despite the risk. Could you please elaborate? I mean, how do you reach this conclusion of yes, a hike is needed after all?
Shall I take the second one and then you take the first? Okay, so I'll take your second one. I'll take you through the reasoning that we adopted. We had indicated, and we are, bound by that intellectual reasoning, that we would approach the assessment using three key criteria: inflation outlook, underlying inflation, strength of the transmission of monetary policy. As I said earlier on the third criteria, there is no question in anybody's mind around the governing council table, if you want to sort of propel yourself into that room. There was shared analysis of that, with little variations at the margin. On the first item, which is the inflation outlook, well, we looked at the projections that were given to us by ECB staff. We looked at experts' reading and analytical work. And when you look at the projection, you see that, I was going to say, notwithstanding the GDP revision, we have a revision upward of headline inflation in both 23 and 24, and a 0.1 revision downward for 25, which is hallowed with uncertainty, because the further out you go into the projection, the less certain it is. On the core inflation, which we look at as well, not only one, but we also look at core inflation. Core inflation is maintained in 23 and revised by 0.1 in 24 and 25. But overall, we are not at target in 25 on headline inflation. We are almost on target on core, and we only hit around 2% in the fourth quarter of 25. So when we look at that, we ask ourselves, okay, inflation outlook, how does that compare with our commitments and our target? Not there yet. And as I said, it's the key sentence in that monetary policy statement. Under current assessment, with this decision of 25 basis points hike, we believe that we are making a substantial contribution to blah, 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 blah. I will not annoy you with repeating yet again. So those are the elements that we take into account. And then the real purpose of what we're doing here is not to be found in that sentence. It's somewhere else in the beginning of the document that you have, where we say, I hope I can find it for you right away. It's in the first paragraph where we say, in order to reinforce progress towards our target, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. We want to reinforce progress. We want to be as timely as is possible. And by doing that, we support our projections with a higher degree of confidence. And I think it will reinforce progress towards targets. So we are determined to get there to that 2%. And we see that as the best way to accelerate the process. And by the way, it also reinforces the anchoring of inflation expectations, which are broadly at 2, but which warrant monitoring.
On how much of a drag is the property market for the financial system? Well, I will follow what the President has indicated before. I think that we have 2 different situations. In the case of the residential market, what we have started to see is that there is a slowdown in the evolution of prices in residential property. Whereas in the case of the commercial property, commercial real estate, the situation is different because we identified a decline in prices even before the tightening cycle of monetary policy. This was related to the situation of COVID, teleworking, and this kind of things. We have made a lot of analysis about the potential impact that commercial property might have in the financial system. And we have identified some channels, some links between commercial property, commercial real estate, and mutual funds. That would reinforce, the comment that I have made before about non-banks as a potential source of vulnerabilities for the financial system. I think that this is the element that we are trying to analyze. There are real estate funds, property funds, that have a lot of investments and a lot of great exposure to the commercial property. This is something that we have to look at and monitor very closely.
Thank you. And the next question goes to Silvia Berzoni of the Italian TV channel Class TV.
Thank you very much. Good afternoon, President.
Good afternoon.
So, given the sharp...
Buongiorno.
Buongiorno. So, given the sharp downward revision to GDP in 2024, which you have already explained, but can you give us a sense of how concerned is the Governing Council about the chance of a recession, and especially in places and countries like Italy, where most, if not all, the economic activity depends on banks?
Well, I think it's in all countries that economic activity depends on financing. So in Europe, it's largely banks, but it's not something that is, peculiar to Italy. Banks in Europe play a critical role in financing the economic activity, both for corporates and for households. We are going through a phase of very sluggish growth. We move from 0 to 0.1 to 0, revised 0.1, revised 0.1. And we see also very weak signs, whether you look at PMI, whether you look at the gap between manufacturing and services that is now being reduced. We are clearly in a period of slow and sluggish growth. But as I said, the revision that we're making for next year, where we're moving from 1.5 to 1% of growth, is for 3/4 of that revision attributable to the sluggish growth that we are going through at the moment. So the difficult times are now. And the recovery that we had anticipated is pushed out into 24. And when you look at the September projection that we have on a quarter-by-quarter basis, it is the same as the one that we had in June, which shows that we are confident that growth will pick up in 24. Now, of course, we need to succeed. We need to bring inflation down, and wages have to be sustained, and labor has to hold. Those are some of the assumptions that we make in that respect.
Thank you. And the last question goes today to our online participant, Mark Boinderman of the Dutch daily NRC Handelsblad. Mark, please.
Thank you very much. President Lagarde, you alluded to the risk of food inflation picking up because of adverse weather conditions related to climate change. I know this happened in 22 already. Have you got concrete indications that this is happening again, and this could in fact impact the inflation number? And related to that, my second question is, has the ECB made any progress in thinking about how to make its operations aligned with the Paris Agreement in times of monetary tightening still? Thank you.
Sure, thank you very much. On the first one, as I said, the food inflation has come down, but it is still at 10% at the moment. So it is still hard for people, because food is obviously a component of the basket, which matters a lot and which matters more for those who earn less. We know that for a fact. So we hope that food will continue to go down, but it's one of the components that is still very high. Maybe I would enlarge your question to the price of commodities in general, because we are seeing movements, whether it is on grains, whether it is on, and obviously the Black Sea Agreement denunciation by Russia is flying in the face of stability, if anything. But whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully, because some of them are volatile, some of them are on the way up, and they will have consequences on prices. I think we will have to assess on a projection by projection basis to really appreciate what impact it has in view of activity around the world as well. You know, we had a good scenario analysis produced by staff about China and the role that China growth or deceleration of growth would have on our own GDP and our inflation. That, combined with the price of oil, is obviously something that we need to be attentive to. On the compliance with the Paris Agreement, as you know, because of the tilting program that we have put in place since last October, that we have improved and modified, we can tell you very seriously that until the end of 23, we are Paris compliant. What I can also tell you is that we need to look at other measures and more measures in order to make sure going forward that we will remain Paris compliant, given the fact that we are gradually, we have phased out any reinvestment under the APP, and under the PEP, the volume of corporate bonds is extremely limited. So we will be looking at that, and there will be work done by staff to propose options in order to remain Paris compliant. Thank you.
Thank you. That's all for today. The next press conference is on 26 October after the External Governing Council.
We'll see you then. A split decision at the ECB leading to a 25 basis point rate hike. That was ECB President Christine Lagarde in Frankfurt, Germany. This is Bloomberg's The Open. I'm Jonathan Ferro. And here's your market 10 minutes into the session stateside. Equities up by 0.5% on the S&P 500. On the Nasdaq, drifting higher as well. Some outperformance on the Russell. A ton of US data we need to talk about. Over in Europe, in the bond market, yields lower. A bond market rally, the 2-year in Germany down by about a basis point, on the 10-year down about 6. In the FX market off the back of that, the euro a whole lot weaker against a stronger dollar. A break of 107, 106.82. We're negative there by 0.5%. President Lagarde did not want to commit to a pause, but there was a strong suggestion the ECB is doing just that.
Based on our current assessment, we consider that the key ECB interest rates have reached levels that maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target.
Let's get over to Frankfurt, Germany with Maria today. Maria, what stood out for you?
Well, Jonathan, as you say, it is a rate hike. It was interesting to hear from the head of the ECB say, I don't want you to think the debate was antagonistic, but it was obviously not a consensus decision. And then she pointed to the solid majority. To me, I thought it was very interesting going into this meeting, as you say, the market really picked up on this line, which said, of course, if you have interest rates at a, quote, sufficiently long level for a sufficient duration, you could have a substantial contribution to a timely return to inflation to the 2% that was seen potentially as maybe this is it. Having said that, and again, this really stood out to me, she was given two opportunities to put this debate to rest. Is this the final hike from the European Central Bank? One, she was asked directly, is this the end of it? And she cited a theater play where she says, well, a door can be open or closed, but that is a theater play and this is life. And then secondly, she was asked, have we reached that peak level when it comes to rates? And she said the European Central Bank could not determine that. So to me, that was striking that perhaps given that opportunity to perhaps settle this debate, she did not. Again, she also said from now on, this emphasis on the data dependency continues to stay, that the central bank obviously has to deal with inflation. We know there were changes made to both the forecast that would point to higher inflation and lower growth. She was asked about stagflation. She was asked about recession. But obviously, at this point, this was not ahead of the European Central Bank that wanted to talk too much down the economy, but also clearly signal that, of course, the downside risks are obvious and they're palpable for this economy.
The theatre is supposed to be entertaining. There was certainly nothing entertaining about that news conference. Maria, thank you. Joining us now is Invesco's Alessio De Longis, Winnie Caesar of Credit Sites. Winnie, you were looking for a rate hike. We got a rate hike. What's next?
So I think that now you do have to have a base case of potentially a pause. We had anticipated another rate hike after this. When you look at Eurozone inflation, it is still objectively too high, even on a 3-month annualized basis, well over 3% if you average things out. And even though the economy is slowing, and as Lagarde pointed out, we're kind of in the midst of that now, those inflation levels really do need to continue to come down. So I would say a base case of a pause, but we do think that another hike is within the realm of possibility.
Alessio, a strong suggestion will get a pause. She read this one quote in the statement about 5 times. No harm to read it once again. The Governing Council considers the key ECB interest rate have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Alessio, did that statement sound like a pause to you?
It's meant to suggest a pause, but I think she did the right thing in not committing to it. While my base case is that rates are going to stay here over the next 6 months, that's my base case. But I do think that the risks, if anything, are tilted towards another rate hike, not towards an immediate cut in the next 6 or even 12 months. Yes, the economy is weakening, but it was a split decision. It was a debate. But if you really look at an unequivocal interpretation of the mandate, you can't raise your inflation forecast for every single year of the horizon down to 2025 and not raise interest rates. And I think given what commodity prices are doing, what food prices are doing, and you alluded to it, the strength that we're still seeing in the U.S. economic data, which we know will tend to lead, as they've done in this cycle, also European data, the risks are tilted that this cycle is not done.
Let's talk about that strength in the U.S. data. 14 minutes into the session, equities are higher here. Mike McKee, upside surprise on U.S. retail sales.
However, John, we had some revisions to July that make the news not quite as good, but it does show the consumer hanging in there. Now, remember, retail sales are calculated by dollar volume, so no surprise we saw a big rise in gasoline stations, up 5.2%. We'll talk more about that in a second. But the rest kind of looks like back to school. Clothing store sales strong, electronics store sales strong. Interesting thing, real weakness in furniture stores. We have seen problems in the real estate business, so that probably accounts for that. It's something like 5 out of the last 6 months we've seen declines at furniture stores. Now, let's make something out of the gasoline story here. The question that everybody's going to ask is, how's this going to affect us going forward? And as you can see, until the pandemic, gasoline sales and non-gasoline sales, gasoline prices, non-gasoline sales sort of went together. Then all of a sudden we started spending a lot on both. And you can see the yellow lines there basically point to the times when gasoline prices rose a little bit and we saw retail sales ex-gas fall a little bit, or at least flatten out. But that's not what's happening on the far right-hand side. How long are we going to see gasoline prices going up without retail sales being affected? That is going to be the key question for the Fed in terms of how the economy is hanging in there. Other numbers out today, PPI does go up. It's an oil price story as well. 60% of the rise in goods prices during the month attributable to oil, according to the government. Initial jobless claims barely moving, and continuing claims, they only go up by 4,000. So at this point, the labor market remains strong. Americans are still spending money, but gasoline looms as a black cloud on the horizon.
Mike McKee, thank you, sir. Energy a feature of the conversation at the ECB in a higher inflation outlook. Mike McKee nailed it there as well. Brent crude, 93. WTI, 89. Alessio, you like stocks, you like risk, you like equities over bonds. You think Goldilocks, and that theme is here to stay into year end. Do you think this move here in crude could disrupt that?
This move in crude at the moment, I think, is actually validating that to some extent. You're not expected to see rising commodity prices when overall global economic activity is that weak. I think commodity prices tend to be more of a, especially energy, more of a coincident indicator of growth, while stocks tend to lead. So commodity prices here are validating a little bit of the move. Now, is that the perfect Goldilocks scenario? Well, not so much if you remain on the verge of raising interest rates at every meeting. But if it's actually eliminating the spectrum of the imminent recession, I think for risk assets, credit, and stocks at this stage, the ability to lower the probability of a recession further out into the future is essential, and that's what's supportive of risk here.
Winnie, is $93 Brent reflection of good things or a recipe for bad things?
I think that I would thread the needle a bit there. You know, we do have to consider what has driven crude over the past week or so, and that has been a reiteration of supply cuts. And we have to look through that a little bit in terms of central bank policy, as the Fed and other central banks are cognizant of commodity price increases, but not necessarily trying to manage their inflation mandate to those headline moves. I think that there's some mixed factors here. Heading into the fall, we had anticipated the consumer to start to slow down. There are a number of different factors, from student loan repayments to that drawdown of excess savings. It is encouraging to see that commodity prices are remaining stable, but they're also quite negative for the consumer more broadly, as you see that increase in energy prices pushing away from the ability to have incremental discretionary spend. So I think it's a little bit more of a nuanced and mixed picture rather than just commodity prices, energy prices higher equals good economy.
Commodity prices are up, the labour market's still tight, unit labour costs might be climbing as well, particularly in Detroit. It's going to be a fascinating day today. The data's behind us, US retail sales, jobless claims, a central bank decision behind us as well. In front of us, a big deadline for a deal between the UAW and Detroit's Big Three. The deal nowhere in sight, with less than 15 hours until the deadline. AMH joins us from DC for more. Morning, Anne-Marie.
Good morning, Jonathan, and that's right. We do not have a deal just yet, and come 11:59 p.m. this evening, that contract ends. And what we heard from Shawn Fain yesterday, the head of the UAW, really in his clearest signal yet, saying that there will be strikes, and unprecedented at all three of these big auto companies, Stellantis, Ford, and GM. Just they're going to be targeting specific plants, Jonathan. This puts the president in a very difficult position. We have seen a number of labor issues come to him in the Oval Office. What the president likes to do is be out front with the rhetoric, supporting labor unions. He claims he's the most pro-union president in history. At the same time, behind the scenes, we do know that the president would like to stop a strike. This is usually how he's operated, whether it was the ports or the freight railroad unions, Jonathan. We do know that a number of individuals in the White House are tasked to deal with this. Gene Sperling is the liaison. We know that Julie Su, the acting labor secretary, is monitoring it. And we heard from Jared Bernstein yesterday, his chief economist. He said they are encouraging everyone to stay at the table. Jonathan, as a president, it's not just an issue for today. this could potentially mean the president losing blue-collar workers that could vote for him next November.
Big story for us today, tonight, and tomorrow. AMH in Washington, thank you. This is what's on the table right now. UAW, big union, wants a 36% raise. This is the offer, according to President Fain. Ford proposed 20% raises over 4 years. GM offered 18%. Stellantis, 17.5%. Winnie, a question that's dominated this program now for the best part of 2 weeks. Do you see this as the dying embers of a hot labor market, or something we've got to live with for the next few years?
Well, I think that there are definitely a lot of real problems in terms of labor supply that are probably going to keep labor markets tighter for longer than a lot of people anticipated heading into the pandemic and the kind of erosion in participation. Now, that being said, recent economic data and recent payrolls data have actually shown some upticks in terms of labor participation. So I'm not necessarily convinced that this is kind of the dying embers of a hot labor market, but I do think that we are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Alessio, what does this mean for the viability, sustainability of some of these industries? I'm not just thinking about autos, I'm thinking about airlines as well. Do you think really they can pass on these costs to consumers, or ultimately they've got to eat this and margins are getting hit?
I think margins will eventually have to suffer here. I think the point that was made on the rising labor participation and some of the relaxation on the costs will be more evident over time. The increases in the labor participation rate are quite meaningful, and they're not only indicative of better supply, but also overall optimism among consumers. But ultimately, I think it will not be possible to keep passing costs onto end prices this way, and margins will have to take a hit. While bullish, as we said, on the overall economic picture, margins are still wide, and given how tight labor markets are, and we are towards the end of the cycle, a compression in profit margins is the longer path ahead.
Alessio, thank you, sir. Alessio De Longis and Winnie Caesar on 3 important stories there. The ECB, the latest data out of the United States, and that negotiation between UAW and Detroit's big manufacturers, the big auto manufacturers. Your market right now looks like this. 23 minutes into the session, equity's doing okay, up by 0.4% on the S&P 500, higher here by 0.2 on the NASDAQ 100, and some outperformance there on a Russell. From New York, your trading diary up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
25 minutes into the session, stocks just about positive across the board here. The equity market on the S&P just about positive by 0.4%. That's the price action. Let's take a sneak peek of the calendar the week ahead. President Biden discussing Bidenomics at 2:45 Eastern. At midnight, the UAW strike deadline. Next week on Tuesday, President Biden in New York for the UN General Assembly. Wednesday, we get a Fed rate decision and Chairman Powell news conference. On Thursday, another round of jobless claims and existing home sales. The data so far this week, so far, so good stateside. Let's see if that changes. From New York, that is it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, coming up, this is Bloomberg Markets. Matt Miller, Paul Sweeney. We are live here in the Bloomberg Interactive Brokers studio. Coming up, we're getting a look, Matt. I think there may be a strike Tonight is kind of what the reporting is. We're hearing that reporting coming out of Detroit.
I mean, hugely important day. It seems like the UAW, the Auto Workers Union, and the big three, General Motors, Ford, and Stellantis, are still pretty far apart, and they've got to come to an agreement by 11:59. We already heard from the union president on a Facebook Live posting yesterday that they're getting ready for partial strikes. Who goes on Facebook Live?
I don't know.
Like my grandmother? Who's on Facebook?
I don't know. But we'll get that. We're going to get all that reporting coming out of Detroit. We're going to get a look at some of the eco data that came out today, and we're going to get some outlooks for this market. That's all coming up in the next 3 hours. But first, we kick it off with the John Tucker.
All right, thanks, guys. Equities are climbing today. ARM Holdings, that's going to debut on public markets in the U.S. Also had the reports on producer prices, retail sales. It's kind of left intact the Wall Street expectation that the Fed may hold interest rates steady next week. We saw an across-the-board beat for August retail sales data this morning. And for John Riding, the chief economic advisor at Brean Capital, this does highlight the resilience of the U.S. consumer.
The U.S. consumer is strong. It's not that the U.S. is roaring, it isn't, but it isn't yet falling into recession given the size of the interest rate adjustment.
We have 10 of the 11 major industry groups in the S&P 500. They are higher. Energy in the lead as WTI hovers around $90 a barrel. Consumer discretionary, the biggest drag. That's where you're going to find shares of Amazon.com down just about 0.9%. Again, waiting for the start of trading at ARM. It was priced at $51 a share. S&P 500 right now, 20 points higher. That's up 0.4%. 44.86 on the index. The Dow Jones Industrial Average up 199 points, up 0.6%. The Nasdaq 100 is 17 points higher. That's up about 0.8%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, very good. John Tucker, we appreciate that.
Why is Matt staring at me?
I'm just... I mean, you're such an attractive man, for one thing. You have so much experience and wisdom, for another.
Exactly. You know? And he's wearing a sport jacket, which is nice. Seeing on the Bloomberg terminal, ARM eligible for trading around 10:20 a.m. Eastern time. If I had to guess personally,
eligible?
I would say 11 a.m.
I would say 1 p.m.
No, they got to get it done. They like to get it done around 11. It's been
they like to, but they haven't been lately.
Yeah, we'll see. This is a big one, and they want to make sure this one goes off well. All right, Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio, streaming live on YouTube. So head on over to youtube.com and search Bloomberg Radio. Again, as John Tucker was just reporting, markets a little bit higher here today. That's nice to see. Let's see where the action is underneath the hood. We do that with a Bloomberg Equities reporter, Alexander Semenova, who joins us live here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at?
Well, guys, great to be here with you as always. As you had mentioned, all eyes today are on ARM Holdings, the SoftBank-owned chip designer. It's set to make its highly anticipated public trading debut today. ARM's IPO could also be a catalyst for IPOs from dozens of tech startups who have been waiting as the IPO market has had its longest listing trough since the global financial crisis. As you mentioned, it is expected to start trading around 10:20 a.m., although some sources tell my ECM colleagues on the equities team that it could be around 11 a.m. ARM had priced the IPO at $51 per share, valuing the company at over $54 billion. That was the higher end of the price range. However, what's interesting is that yesterday at the final price-setting meeting, some bankers and executives had floated, moving it up to $52 per share. As of course you guys remember, the offering was oversubscribed more than 10 times, meaning investor interest had far exceeded supply at that price range, so they made the case for $52. But SoftBank founder Masa Son apparently came into that meeting and said, let's keep it at $51, opting to be more conservative. He apparently said that risking a healthy debut wasn't worth the $100 million or so in additional proceeds.
He just bought a 25% stake in this from his own fund for far more.
Yeah, I guess, you know.
This is a guy who just, burning money does not hurt him.
No.
As he's proven. I think they had a $30 billion loss last year?
Yeah.
Carnival.
Carnival.
Let's go to. I mean, yes, we're all watching ARM. Let's talk about Carnival, because a big gain in pre-market trading and Norwegian Cruise Lines as well. What's going on there?
Yeah, Carnival and Norwegian shares up more than 4% last time I glanced. That's after Redburn Atlantic lifted both stocks to buy from neutral. I actually never heard of that firm.
No, Redburn Atlantic.
But apparently,
based in London,
investors were very happy with that. They said that the cruise line sector has now, quote, exited intensive care. Analyst Alex Brignall wrote that factors that made him positive pre-pandemic, like growth prospects and margin opportunity, are even stronger now. He also cited that debt is falling and profitability is improving, which makes the fundamental case.
We had the CEO of Viking Cruise, which is primarily a European cruise lines. They do ocean cruising, river cruising, all that kind of stuff. We had the founder and CEO on a couple of days ago. They're taking bookings into 2025 now. They're pretty much booked through 2024. So, I mean, the demand side seems like in that industry, as you would expect, I guess.
Definitely. I mean, well, it's a little bit of different of a different business, right? Because Viking and Lindblad, these are kind of high-end river cruise, kind of snooty expeditions.
On the demo.
You are their demo, as opposed to
like Alex. Alex is not going on a Viking cruise.
Alex is more likely, she's going to hit the Bahamas. All you can drink.
You guys know me too well.
Exactly. All right, Visa is down. What's going on with that company?
Yeah, not a great day for Visa today as it moves to let some of the biggest U.S. banks eventually sell their shares. Visa's proposal will allow holders of its Class B shares, that includes banks including J.P. Morgan Chase, Citigroup, Bank of America, to sell as much as half of their stakes. That's $96 billion worth. Their ownership was part of a share structure implemented before Visa's IPO in 2008. The company was previously owned by these banks, and at that point, the structure was so that they'd be on the hook to cover the costs of longstanding litigation they had with some merchants. Various analyst reactions here. Morgan Stanley said that the exchange reduces the overhang from wondering how this would eventually be converted. Jefferies said that they do expect a modest overhang from the forthcoming sale pressure.
Yeah, so I don't know. You think about fintech, and I talk to a lot of fintech analysts, or whenever I do talk to fintech analysts, they say you can buy a lot of these new names, but you know what? Just go buy Visa. Go buy MasterCard. I mean, those are the systems upon which a lot of this new technology is going to ride on. And if you want to play just broader fintech themes, go buy Visa.
That's definitely what Visa and MasterCard will tell you.
That's what exactly they'll tell you. But it makes sense.
They've both had incredible runs since that IPO.
All right, good stuff here. Appreciate it. Alexander Semenova, thank you so much with that overview of what's happening in the marketplace right here. Matt, again, you're the car guy. How concerned are you about this strike?
I'm hugely concerned about it, and not just because of the car I'm waiting for,
which is the Dodge
it's being built in
Challenger.
Canada. It's the Dodge Challenger RT Scat Pack wide body. I've been waiting quite a long time. But really, you're going to see a lot of people in a similar situation, waiting for cars, and not just consumers, dealers, right, that don't have a lot on their lots already.
But we just heard that they actually do now. We heard from Alex Naughton covering
Keith Naughton.
Keith Naughton, thank you, Keith Naughton. Yeah.
Okay, so
but let's
maybe they have a few weeks of inventory left on their lots, because if these strikes are widespread, and again they're going to be targeted at first, it's going to be a problem for dealers for sure, and then for prices and for inflation and for the economy.
This is something that is a Detroit issue. It is a Washington D.C. issue. That's why we got a nice roundtable here, Matt. David Welch, Detroit bureau chief for Bloomberg News, and Jordan Fabian, White House reporter for Bloomberg News. They join us. We're going to roundtable this thing a little bit. So, David, I want to get the latest reporting out of Detroit. What's the expectation? Will there be a strike? And if so, is there any expectation of how long it may last?
I think there certainly will be. All of the vibe coming out of the union right now is the president is itching to strike. He says he's not, but he's making plans. The rhetoric is still really strong against the car companies, against rich executives, all of that stuff. So he's getting people riled up. He says they're far apart. It doesn't sound like they are if you look at the numbers. So I think they will. And look, it could go on for a while. I don't think it'll be something like 3 months, but I could see the strike going on for weeks, and it could vary by car company too. It doesn't necessarily. It could be 2 days at one and 3 weeks at another, right? I mean, if he gets the deal he wants from specific companies.
So, David, how far apart are they? Because I've read now that the union has lowered its demand for pay increases slightly, and the last I saw from automakers was about double what I had seen a week ago. So, how far apart are they right now?
Yeah, so look, Ford is up to 20% and GM is at 18% pay raises over 4 years, which is, I think, better than they've ever gotten. So, you know, I think, and it's not the 36% they asked for, but I think that was sort of a highball offer from the union to begin with.
But they asked for that because the chief executives have gotten those kinds of pay increases over the past 4 years as well, haven't they?
That's right. And look, you know, CEOs got to kind of be careful what they wish for, right? Because, you know, suddenly they might have a union saying you got 40% and why didn't I? And the union didn't get great raises over the last contract. And I'm sure some labor negotiators at the companies got bonuses for negotiating a pretty low-cost contract last time. And they used to be careful what they wish for because now they've got an extremely angry union but they do. And with a president who wants to make a statement about labor's role in America. This isn't just about this contract with him. He wants to bring the labor movement back to prominence in America.
All right.
And
all right, so
that's where we are.
Yep. Jordan Fabian, let's bring you in. You cover the White House for Bloomberg News in Washington, D.C. The President Biden, he has said twice that there won't be a strike here. What are you hearing out of the White House?
I think that's the president being his usual optimistic self. Other people I've talked to aren't so optimistic, and you know they see what we're all seeing, which is a union and management still apart on a contract, and you know they have encouraged the sides to stay at the table. But you know some people I've talked to have said, look, we don't know how this is going to end. It's all we can do is kind of encourage them to keep talking, but there's really not much we can do to force them to get a contract. So they're crossing their fingers and hoping there's not a strike, and if there is, it's not a long one.
You know, Jordan, David points out that this president wants to bring unions back to prominence. At the same time, he has backed up truckloads of subsidies and dumped them on the automakers' doorsteps to try and encourage them to build more electric vehicles, for which, by the way, we don't even know how much demand there is. That is going to require far fewer workers. So is he working at cross purposes?
This is the central dilemma for Joe Biden is you know, this clean energy transition is one of his biggest domestic priorities. But guess what? So is empowering the U.S. labor movement. And in this negotiation, he's found himself caught in the middle of those two priorities, and there are really no easy answers. The administration has done something recently. They've released this $15 billion tranche of money from the Energy Department to incentivize factory retooling, and they've put some strings attached there. They're encouraging car companies to use that money on unionized plants and make sure the benefits go to union workers, but they're not forced to. And this has been the bane for Sean Fain, which is he doesn't think the administration imposed enough conditions on all this money that's going to the car companies. And so in addition to the pay and benefits, this EV transition issue has been at the backdrop of this negotiation, and it's really causing political problems for Joe Biden, because he needs all the union support he get going into 2024. And here you have this major union on the side saying, not so fast.
Hey, David, do we know how this union will strike? Will they strike one automaker, all three? Do we know kind of their strategy?
I think they will strike all three. And what they've said they're going to do is they'll strike individual plants. They're not going to walk out on the entire company. That's one way of minimizing the payouts from the strike fund, which pays workers some money while they're striking. And if they struck all three at every plant, they'd run out of money in about 7 weeks. They don't want to do that. So they'll strike individual plants, and what I think they'll do is they'll strike the plants that make the most profitable vehicles, which would be the large pickup truck and SUV plants. because that, if you were to take down Ford and GM's large SUV and pickup plants, I mean, it's something like 70 or 80% of their profits come from those vehicles. You do a lot of damage and put a lot of pressure on the companies very quickly while paying minimally out to your strike fund. And then if they don't get a deal, they can kind of keep, adding another plant here and there. They could strike parts plants that supply the dealers with replacement parts for customers. That could create a lot of chaos. There are a lot of ways they could, with individual plant strikes, they could apply a lot of pressure.
Hey, David, just person on the street in Detroit, which way are they leaning?
I mean, look, that kind of runs the gamut, but I think, it's a union city, so there's going to be a lot of sympathy for them. It's also the Detroit city proper. There's a lot of poverty there. So, strikers trying to get what they think is their fair share would probably have a lot of sympathy. You move further out in the state and you start to see comments on social media like 40%, 32-hour work week, you guys are on crack. I've read stuff like that. So Michigan's a very bifurcated place in that sense.
I mean, 40% seemed like a lot to me at first also, until I read that the chief executives were getting that. And this is an industry that was bailed out by the U.S. government
there you go.
during the great financial crisis, and a union that gave a lot of help, frankly, that accepted a worse contract in order to help the automakers stay alive. Now the automakers have made a ton of money over the past 10 years. And Jordan, from that perspective, doesn't the president from Scranton, Pennsylvania, who cares about the scrappy workers, doesn't he go march with the union when they strike?
That would be quite the image, wouldn't it? Joe Biden holding a picket sign. But
that's what he wants us to think of him, right?
He absolutely does. He's repeatedly called himself the most pro-union president in U.S. history. He did put out a statement about a month ago that did voice support generally for some of the union demands, like better pay and benefits, making sure if there's factory retooling or closing down that the union members are taken care of and that they keep jobs in union communities. But look, he also needs these corporations. Like, he needs them for the clean energy transition. Not to mention, he needs the corporate America on side to give him campaign donations for his reelection campaign. So that's why you're not going to see him wearing that red shirt that Sean Fain was wearing in that image.
All right, fellows. Thank you so much for joining both of you. Jordan Fabian, he covers the White House for Bloomberg News, and David Welch, Detroit bureau chief, out there giving us kind of the feel for the two sides here. Again, midnight tonight, Eastern time is the deadline, and then presumably the unions will go out on strike, and we'll have complete coverage up until that point. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Good morning, Paul. Shares of ARM will begin trading on the NASDAQ today. The chip designer, which is backed by SoftBank, priced its IPO at $51 a share. That's the top end of the range. Bloomberg's Swetha Gopinath says it's a turning point.
The IPO market has been pretty depressed for the last 18, 20 months. So this is the big deal that we've been watching out for. And if it trades well today, it could really open the floodgates in a way. We could see a number of other tech listings follow through. So it's a key moment for the global equity capital market.
As sources tell Bloomberg, ARM's offering was oversubscribed more than 10 times. Stay tuned right here to Bloomberg Markets for exactly when it does begin to trade. Caesars and MGM have been hacked by the same group within several weeks of each other. Bloomberg's Ed Baxter has that story.
Caesars Entertainment is expected to disclose details of the hack of its system soon, but Bloomberg sources say it looks to be tens of millions of dollars. The group behind the attack and the one on the MGM are attributed to a group known as Scattered Spider, or UNC 3944. The Caesars hack first hit an outside vendor before gaining access to the company's network. Members of the group are believed to be young adults, some as young as 19 years of age, residing in the U.S. and the U.K.
All right, let's check in with shares of Caesars and MGM right now. Caesars down just a fraction. MGM shares down about 0.5%. And Subway has launched a 3-inch sandwich. It's being released in Pakistan. The country of almost 250 million people is really struggling with Asia's fastest inflation, which has seen double-digit percentage increases fuel a cost of living crisis. Well, those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. U.S. retail sales and producer prices, they both rose in the month of August by more than forecast. It was driven by higher fuel costs. Still, consumers have remained pretty resilient in the face of these headwinds. The figures keep open the possibility the Fed's going to raise interest rates again this year. Now, with U.S. crude oil higher and hovering about $90 a barrel, energy, the best performing major industry group in the S&P 500 right now, and shares of ExxonMobil, they're up 1.5%. Then you have Delta Airlines reducing expectations for third quarter profit on higher fuel prices. Right now, those shares down just about 0.5%. Overall, S&P 500 up 15 points. That's a rise of 0.4%. 4482 on the index. The Dow Jones Industrial Average up 133 points, and the Nasdaq 100 11 points higher right now. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller and Paul Sweeney here in our Bloomberg Interactive Broker Studio, streaming live on YouTube.com. We had the European Central Bank hike interest rates for the 10th time to quash inflation. The deposit rate now 4% up from 3.75%. Where do we go from here? Are they done? Let's check in with Dr. Richard Portis, professor at the London Business School. Professor, thanks so much for joining us here. A, what do you make of the ECB's move today? And then B, are they done?
I'm disappointed. I don't think they should have hiked today. The pressures on the European economy are very great now, and growth forecasts are just falling and falling. The latest European Commission forecast, independently of the ECB, has cut back their forecasts considerably, so that I think they're pushing us into a recession, pushing the Eurozone into a recession, and that seems to be unwise. What they should have done is wait, in my view. The data are mixed. Otherwise, the inflation data are mixed, and it would have been better to hold on.
They only have one mandate, though. The European Central Bank, unlike the Fed, doesn't worry or isn't supposed to be focused on the labor market and, I guess, economic growth altogether. Their only job is to keep inflation at a steady level.
Excuse me. They're talking about, they're big into climate and all that. They're criticizing the Italian government for their windfall profit tax on banks. Their single mandate has a very broad scope. And actually, if you look at it, they are required to take account of their actions on the overall level of economic activity in the Eurozone.
All right, so you're worried that they essentially pushed the Eurozone into a recession. We're already seeing, that in some of the biggest economies, in Germany, for example. But they have said this is their final rate hike. Does that? Well, they haven't said it actually. Let me step back. In fact, Christine Lagarde said she can't say that, which she can't, obviously. But you can read between the lines and see that this is their final rate hike. So, does that kind of blunt the? Does that kind of reduce the damage effectively?
Well, if it really is final, yes, that reduces the prospects of damage. But still, I think they've gone too far, and we'll see what happens. The inflation data are not particularly good, that's for sure. But it's turning around. It has been turning around for a while, and I think the wisest course is to wait. But there are several people with strong views in the governing council of the ECB, who think, no, we must stamp on inflation dramatically. And that's what they're doing.
Professor, here in the U.S., the talk has been about a soft landing. That is not the case in Europe. Could you give us your view of kind of where the European economy is, how we should think about it maybe on this side of the pond?
It's certainly not a soft landing here in Europe, and I include the UK in that, of course, as well. But I think that's where we've got to. The labor market is holding up fairly well, as in the U.S., for that matter. But economic activity is slowing down very considerably, and how long they can take that. The politicians are coming. European elections are coming up, not just in individual countries, but also the European Parliament elections are coming up, and there's going to be a lot of criticism of the ECB if indeed we find the Eurozone going into a full-scale recession.
I wonder, how hesitant you are to include the UK when you talk about Europe, because aren't there very big differences? And to some extent, the UK has, kind of repeatedly shot itself in the foot.
Well, I mean, depends which gun you're talking about, doesn't it? Was that the left foot or the right foot or both at the same time? Yes, I'm afraid we have done. And right now, there seems no prospect of that reversing. But here, too, I believe we should not be raising rates any further. The data are turning around. They're turning around for inflation. They're turning around slower than one would like, for sure. But the cost of the restrictive policies is high. And that, I think, is unwise. Otherwise, the banking sector is in pretty good shape, both in the Eurozone and in the UK. How long that will last, we don't know. But the rise in interest rates has, of course, widened net interest margins for a while. They will come down as banks have to pass on some of the interest rate rises to the depositors. But the financial sector is in pretty good shape in general. And it's just the main suffering is in manufacturing and to some extent in services. And that's serious.
Yep. And Professor, when you talk about manufacturing, European manufacturing, I think most U.S. investors think Germany. Could you tell us about how we should be thinking about the German economy here and maybe the outlook?
It's not a pretty picture. The problem is partly a slowdown in external demand from China, in particular, and that is very substantial and very severe and has a big impact across a wide range of German engineering firms. So that's a big deal. The unions have pushed wages up, and German manufacturing is there's not a sector I can think of right now that is balancing this trend downwards. And if you look at the data, they're pretty depressing. So and it's not easy to see how that's going to turn around. Actually, the finance minister is a very conservative, shall we say, minister, and he certainly has no intention of any fiscal expansion. Indeed, just the other way around. The prospect for next year for Germany is fiscal contraction in the face of this gathering recession. That seems to me very foolish.
What do you think the solution is to the problems that the European Union faces in terms of monetary policy? You've got this one, organization setting monetary policy for so many different and diverse economies. Does that, you think, work? Has it worked out so far? Does it need to change?
It's always, if you look at the United States, you have a single monetary authority setting policies for states as diverse as Mississippi and California, not to mention Illinois, where I grew up a long time ago. It's this one-size-fits-all problem is a problem you have in any large single economy. and to the extent that the Eurozone is a single economy, it is diverse. And you're going to have areas where, even in the UK, we've had this conflict in part with monetary policy having different impacts on London and, say, the Northeast. And there's nothing you can do about that. You have to have a single monetary policy. You can't have different interest rates for different zones. So the one-size-fits-all problem is there. It's no more acute, in my view, in the Eurozone than it is in any large, geographically diverse economy. But it's true that you have very different, for example, in the Eurozone, very different rates of inflation. In the Baltic countries, it's been much higher than the rate in France, say, or Spain. And Spain, where Spain has been very low.
Yep.
So that's something they can't do much about. They can't do anything about.
Right.
But it's not special to the Eurozone.
Okay. Dr. Richard Porteous, thank you so much for your time. We really appreciate getting your thoughts and analysis. Dr. Richard Porteous, he's a professor at the London Business School. With our news in New York City, here's Michael Barr.
Thank you, Paul and Matt. A Georgia judge decided today former President Trump and 16 of his co-defendants will stand trial separately from two others. The judge said Kenneth Chesebro and Sidney Powell will go on trial October 23rd as previously scheduled. The other 17 defendants in the Georgia election interference case, including Trump, would stand trial at a later date. A hurricane watch is in place for portions of Maine, while a large area of coastal New England is under a tropical storm watch, as Hurricane Lee is expected to reach the region later this week. Senators spent much of yesterday meeting behind closed doors with leaders of the big tech companies. Bloomberg's Nancy Lyons reports on their concerns about artificial intelligence.
More than 20 leaders from tech companies, including those who head up Meta, Microsoft, Alphabet, and Tesla, were part of the discussions. Lawmakers want their input on how to regulate artificial intelligence before it's too late. Elon Musk spoke during one of their breaks.
I think the consequences of AI going wrong are severe. So we have to be proactive rather than reactive.
Musk considers AI a civilizational risk to humans everywhere. Senator Chuck Schumer, who organized the summit, says he's pushing to bring lawmakers up to speed on the rapidly evolving technology. In Washington, Nancy Lyons, Bloomberg Radio.
A federal judge declared the Biden administration revised version of DACA to be unlawful. The federal policy prevents the deportation of hundreds of thousands of immigrants brought to the U.S. as children. Veronica Garcia is an attorney with the Immigrant Legal Resource Center.
It's still upsetting because it leaves so many people in limbo, so many DACA recipients in limbo. But I would say that it's upsetting, but not unexpected.
An appeal is expected. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day when traders are digesting a batch of strong economic data. The market also awaiting the start of trading in chipmaker ARM. Still waiting for that. The positioning window has started. Consumer is resilient. Sales at U.S. retailers rising 0.6% for the month of August, climbing for a fifth straight month. And then wholesale prices jumped 0.7% for the month of August. That's according to the PPI. The gain largely because of rising energy costs. Crude oil right now, this is NYMEX, up $1.63, $90.15 a barrel. Ben Gutteridge at Invesco says there's quite a lot to like about U.S. stocks.
The backdrop is of resilient growth and a policy cohort that will probably decide to go on hold from here. That type of mix, resilient growth, more accommodative or less hawkish policy could fuel yet more gains in the U.S. equity market.
Right now, the S&P 500, 25 points higher, up 0.6%, 44.93 on the index. The Dow Jones Industrial Average up 188, and the NASDAQ 100 right now 86 points higher. That's up about 0.6%. And Adobe set to report its results after the close of regular trading. The earnings call will likely focus on its AI. Also, you have HP shares falling after Berkshire Hathaway said it sold $158.5 million worth of shares of the personal computer maker. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube. So just head over to youtube.com and search Bloomberg Radio. All right, when I first learned about this whole REIT thing years and years ago, fund flows from operation, that's the profitability metric that these people focus on. FFO. I thought it was a scam.
When you're talking about a real estate investment trust.
I know, it's kind of the thing. I thought it at the time was a scam, but now I understand how it works.
That's their free cash flow.
No, it's like their EBITDA. Oh, I think. I don't know, but well, our next guest can help us out. Christine Mastandrea, she is the COO of Whitestone REIT that trades on the New York Stock Exchange, WSR. Christine, Whitestone REIT, tell us about your company. What kind of real estate do you guys own or do you guys focus on?
So primarily, we focus on neighborhood retail. So this would be your high visit, great corners with traffic, and pretty much based on convenience versus soft goods.
So I think about the pandemic. In my home, in my town in Jersey, lots of, and we have a very vibrant downtown in New Jersey. Lots of businesses went out of business. So a lot of for sale, for rent signs.
What is it? Short Hills?
Summit.
Yeah.
And better town than Short Hills. Better train station. Which is why I chose Summit over Short Hills. Better train station. Some people choose the name.
I just wanted to make it clear because I can imagine properties like that in Short Hills or Summit. I can imagine properties in Scarsdale and Bronxville. This is where.
So what happened to your properties then, and kind of where are you now?
So we had the fortune of being in two very strong markets. So we're in Texas and Arizona.
Oh, nice.
So our rebound from COVID was much, much quicker. In fact, I think we're affected maybe for 6 months.
Really?
So, we had very few tenants default.
Yeah, because you guys didn't shut down, do the mask thing.
Didn't.
You just partied, right?
Well,
yeah, on the Ozarks. And
there was a little bit of that going on, I'd have to say. And our restaurants, for a while, there was a little bit of spacing, but... they rebounded really quickly, and then quickly after that, same thing with fitness and all of our other operators.
So what is this? You're not just the COO of Whitestone REIT, you're also a professor of commercial real estate and strategic management at Rice Business School. What is this fund flow from operations? What's the significance of that for a REIT?
So it's a little bit different than EBITDA, right? Okay. I mean, as far as profitability. So what you have to take into context is we're an asset-heavy business.
Yep.
And so that means you have to reinvest capital into the business. And so that takes that into account. So it's a little bit different as far as getting to a bottom line number.
A free cash flow thing.
I was thinking maybe it's somewhere in the middle.
Yeah, maybe somewhere in the middle. But anyway, they buy off on it. All right, so at Whitestone REIT, you're Texas, you're Arizona. What's the growth story for your company? Is it acquisition? Is it just increasing the the number of the vacancies and all that kind of stuff? I mean, not the vacancy, the occupancy.
So I think there's a couple of different components of our business. So first of all, occupancy. And the big part about occupancy is you don't just want to fill the space, you really want to successfully serve the neighborhood. So making sure that you have the right merchandise mix is very important to what we do. That's number one. Number two, we also take a number of centers. We have a number of our centers in our portfolio that we redevelop. So that's improved the look, the feel, the customer convenience for that center. It may also be taking out some parking because now you don't need as much parking. You don't need that same and building in some density as well. And then along with that, we do acquire. And so there's always that opportunity for acquisition. It's been a little challenging right now because the pricing for product hasn't quite adjusted yet with cap rates, but we're starting to see that loosen up.
You're the tiny house people of real estate, of commercial real estate, right? You're looking in smaller spaces, less parking.
Yes.
And I guess the stores are closer to each other. What's the benefit of that over big?
So I think small is beautiful. And one of the reasons why is because if you look at, so our space size is about 2,500 to 3,000 square feet, and our centers are around 50,000 to 150,000 square feet in size. So that 2,500 to 3,000 square feet has the widest range of uses out there. So it's the most flexible real estate. So when you think about a mall, it's not really that flexible, right? Yep. It's large, it's big box. There's not a lot of users that can go in and out of some of those spaces, especially a power center. But in our case, we primarily are service-based and necessity-based. So this gives us the most flexibility to meet the neighborhood needs with that size space.
So what are some of the typical tenants, or maybe an anchor tenant, or what are some of the areas of growth in terms of tenants now?
We've found so I found that what has transitioned the most going in 20 years in this business is that, number one, grocery anchored used to be where things were at. But if you think about where the competition is for grocery, it's really restaurants. And that has everything to do with convenience and the experience. So we've seen this real explosion in the restaurant uses in most of our centers. And so that's been the primary driver of
Is that
traffic.
like a Chili's or something like that as an anchor? Or more local?
It's more local.
Oh, okay.
In fact, so many people, that's part of the experiences that people are looking for right now is the taste of food and chef-inspired and so on and so forth. So especially in Texas, we have a very, very broad range of restaurant uses all the way. Houston in particular is very international.
Well, Texas is, I mean, it's a country in and of itself. I mean, I know you guys like to think of yourself as not even part of the country, but in Texas, I mean, it's so big. Is there certain parts of Texas that you guys focus on, or more urban areas or more rural
so,
areas?
Texas was its own country.
I know.
Right.
They teach that up here. They teach that up here.
They're very proud of that. Primarily we stay in the fastest, largest growing cities. So we're in Dallas, San Antonio, Austin, Houston, and then we're in Phoenix and, the Phoenix East Valley as well, so which is also fast
So you want to have a neighborhood
Everybody's
feel.
moving there. I mean, what's it like in your markets? Everybody's moving there, right?
Oh, that's been very, very exciting. So I think we jokingly call Phoenix Chicago West and California East. So because that's really changed. So finally in Phoenix, you have really good Italian food. Thank you for Chicago. But on the other side of that, I think that in particular, Dallas has had such a growth strength because they've really focused on the job market and Fortune 500 to 100 companies. So they've gone after that group of that job market. Austin has done extremely well, and because of that, San Antonio, as people are starting to move to San Antonio, so you have, of course, the educational system that really pushes that, and you have high tech there. I mean, with Michael Dell, he has, created his own ecosystem there of tech. So, and then Houston has been, viewed primarily as oil and gas, but what's really changed with Houston is that they've gotten heavily, it's the largest medical district in the world, so that's shifted as well. So, a lot of people are moving there because it's a business-friendly state, but it also is the job drivers, just the job growth has been tremendous. And then we're seeing the same in Phoenix, and especially there, it's getting younger. It used to be a retirement community, but you have ASU, which has been a huge, proponent of change there as well.
It's a little hot in your markets, though.
But it's dry heat, Paul.
But these guys, their entire summer was like 120 degrees. Unbelievable.
It's been a little steamy in Houston, and then Arizona. It's very hot. So
wow. All right, but great markets, great growth markets. Christine Mastandre, thank you so much for joining us. Christine is the COO of Whitestone REIT, the New York Stock Exchange ticker to put into your Bloomberg terminals, WSR. We're gonna have more coming up. The S&P up 0.6%. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Apple just introduced it, and now wireless carriers are ready to offer up deals on the new iPhone. More from Bloomberg's Gina Cervetti.
The biggest phone debut of the year comes with the smallest price tag as the cell phone carriers unleash major deals tied to Apple's new iPhone 15s. AT&T, T-Mobile, and Verizon are offering the models with $1,000 discounts or at no cost. The promotions will likely test just how much cost the companies are willing to shoulder.